Today, we'll talk about a very crunchy topic in the space as we have more and more institutions coming, and that's privacy. So first of all, I'm glad to be here with three amazing experts, panelists, to talk about privacy. So would you mind starting to introduce yourself?
Hello, really nice to be here. My name is Min Shi, leading product and engineering at the Asta Foundation. At the Asta Foundation, we have been building a blockchain ecosystem focusing on Japanese market, working closely with Japanese enterprises, aiming to bring more consumers on top of blockchain. Recently, we have been switching our focus from our previous layer 1 blockchain to Asta Stack, a vertically integrated consumer stack containing user-friendly interface, security tools, and fun hardwares. Yeah, thank you so much.
Thanks for being here. What about you, Beatrice?
Good morning, everybody. My name is Beatrice Callahan. I'm the head of sales for Asia Pacific for Digital Asset, the company behind the Canton network. It's great to be here on our home turf this morning.
Good morning, everyone. My name is Matt Blumberg. I'm head of DeFi at Ondo Finance. We focus on RWAs, specifically the most liquid ones. We're number one in terms of TVL across multiple categories, tokenized treasury bills, as well as tokenized equities. Tokenized equities launched back in September, and in just a few months, we've hit 65% market share. So very excited to be here.
Great. Thanks for being here. So let's start. I guess privacy is not a default of blockchain today, right? You can see everything on Dune. You can see everything on Arkham. You even have sometimes bounties to flag some of these wallets if they're not identified yet. So as institutions are coming to the space, why do you think privacy is important, and how do you make that happen? Starting with you, Mingxi.
Sorry, I'll skip this question first. And yep.
Okay, well, I think the privacy question is actually something that's very important, and we're seeing it a lot in the market. In digital asset, many of you may know us for the Canton network, which was launched in June of 2024. So we've only been around for about 18 months, but digital asset, the company behind the Canton network, has been around since 2014. And we realized that the most important thing to be able to bring regulated financial institutions on chain is the importance of privacy, granular privacy in everything that you do in the protection of your assets, in the process of tokenizing your assets. The importance of having privacy is the only way you're going to bring the institutions necessary to scale the industry on chain. And that's actually the Canton network. The heart of that is through a modeling language called DAML, in which you're able to write out who a party within a business situation or a workflow is, code up who has the rights to see what, who can be a signatory, who is able to do different things. And then as you post those assets on chain and automate a process, those privacy controls are ingrained in it. So previously, when you had public blockchains, you were able to actually access information about your competitors, about other people on chain, and that was what was preventing regulated financial institutions from coming on chain. If you're able to have an open network, an interoperable blockchain network, but actually have privacy controls there as well, you're able to really prevent that trade-off that we previously saw in the industry. And I think that's an important thing to note, that you need to be able to have both in order to see the growth that we want to see and the adoption that we want to see as a market as a whole, rather than individual institutions having, say, private blockchain islands.
Right.
Yeah, I mean, I certainly echo the point that building into a world of private blockchain environments is not really why we're here, right? So at Ondo, most of what we focus on is really access, right? And at the end of the day, that means we tend to build products that do primarily serve retail users. But I think when it comes to privacy, everybody sort of needs a level playing field, right? Where is the line between retail and institutional, right? It's not immediately clear. And I don't think it's immediately clear that anybody demands different features from anyone else. So I think in general, when it comes to, when it comes to privacy, everybody on the institution, like people in retail don't mind if they have privacy and everyone else has privacy, right? Like it doesn't really impact me if you're trading on a decentralized exchange and like I don't know who you are. On the institutional side, everyone wants privacy for them and for no one else, right? And so I think it's like a little bit overly simplistic to think that like, oh, if only we had good privacy on blockchain rails, like the institutions would be here and all our coins would be mooning, right? In practice, it's much more nuanced than that. And a lot of times what I see is crypto natives immediately understand how important privacy is. We've all used block explorers. We've all, tracked wallets. We've all seen accounts tweeting about large purchases or sales. For the institutions, it's just like one part of the world that they're trying to wrap their heads around, right? And so usually for us, we're like, it's immediately clear that obviously you don't want everyone to see what you're doing on chain. I don't know about you guys, but I use a lot of wallets, right? So that it's annoying for me to track come tax season, but it's easy for me to feel comfortable transacting across different chains. For the institutions, they're like, oh yeah, privacy, didn't think about that one. Wait, let me talk to the regulator and get back to you, right? So I think it's a pretty complex topic, but it's obviously something that like, there are clearly use cases where we're gonna need that for anyone to really come into the space.
Yeah, and actually just to echo on from that, I think one of the things, as you said, is important is finding that sweet spot in between. At Digital Asset, we started off in the kind of blockchain enterprise side of things. And what we were seeing were a lot of these very forward-thinking companies deciding on creating like supply chain finance consortiums or trade finance consortiums. But the problem is your competitors don't want to be part of your own kind of blockchain enterprise. It means that your information is visible to them, and why on earth would they join that? That also then ends up in the situation where you've only got these blockchain islands in which some companies are able to scale, but you're not getting that ecosystem effect. The essence of what needs to happen and where privacy actually enables things to do is that connectivity across all of the different institutions on a network and the transfer of assets across. Without privacy, you're going to have this kind of isolation kind of ethos taking over as people are competitive. No one wants to share their information with their competitors, but also no one wants to share their information with other people that have access to it, and you get that on chains. I mean, we were speaking yesterday about stable coins, and obviously one thing that we all want in the industry is one day to be able to go to a coffee shop and pay for your coffee using stable coins. But the problem with that at the moment, by using an open public chain, is not only does the coffee shop know that how much your coffee cost, actually you can then see where you bought your coffee yesterday. Your colleagues can see how much you spent on your coffee. Your colleagues can see how much you were paid by the company that pays you. And that information, fine on a retail level to a certain extent, but on an institutional scale, that's impossible. You're never going to see the scalability or the interoperability that we need in the industry to really kind of create the value add of being able to tokenize assets, extend them on chain, and then cross transfer. So very much agree with you.
Yeah, really echo with the points above. And I think what really matters here is just to have control over what information to be exposed. And sometimes it's actually about selective privacy. It's not about privacy, only about privacy. It's about selective transparency, having different layers of options, having the commercially sensitive data to be private, but also having those information that really benefits from blockchain's finality, composability, and transparency to be publicly visible. And also having the information sometimes may need regulatory oversight to be verifiable and auditable on top of the blockchains. That's also some of our experience from dealing with Japanese enterprises, although it's still very many blocks on the regulation clarity side.
All right. Thank you. So I think we all agree now that privacy is important for institutions, but not only, right, for retail as well. You were mentioning, Matt, that you have so many wallets, and I'm pretty sure you don't want anyone to know exactly what you have on your wallets once they've been flagged.
I mean, sometimes you do, though, right? Like, we actually see a lack of, not lack of privacy or transparency. Sometimes it's a feature. If you think about, like, an investor, a liquid fund, right? A lot of times people try to buy and sell things in a large size to send a message. And a lot of times it's also helpful for people to be able to see that you're putting your money where your mouth is, right? So if you're talking about, if I'm up here on stage telling you how important privacy is, and then I go and put all of my net worth into Zcash, I mean, it's not a great example because, it's not necessarily private, but it's helpful actually to see that someone is doing something the way that they committed to. So I think there is also some set of benefits that you get beyond what TradFi can offer you, where anybody can come in and verify that things are being done in a way that they thought they were.
Yeah.
Right?
No, I totally agree with you. I mean, at Canton Network, you use the distinction of having a glass house. Obviously, there are certain scenarios in which you want to be able to see, all the gold in a room, but the walls are glass. You can see what's there, but you don't know who owns it. You don't know how much they bought it for, et cetera, et cetera. There are situations in which that is a necessity and that's actually a value add. What we like to describe it as is actually, what are you able to do if the building of all of these offices is public? Everyone's able to enter. However, your own information is locked within a specific office. And this is kind of the ethos of the Canton Network. We have this, if you take the example of islands, you have the sea, which is the network, and then you have all of these boats, which are validators. No one else can access your data. That's private. But if you want to be able to transact and you want to be able to move an asset from one subnet to another, you're not connecting the subnets. You're not connecting these different islands. You're using a validator to go across these synchronizers to be able to transfer that information in real time with the benefits of having the visibility and transparency only to the legally required institutions. So I think finding that hybrid approach, which in my opinion is the Canton Network, is great, but all those value adds are very important to scale out the industry as a whole.
And I mean, I think you said it as well. You want to have the option, privacy or transparency, and you still want to have this meta liquidity between all these assets, because if you have the privacy feature and then you lose the scalability and the liquidity and the pooling essentially of all assets through a blockchain, then you lose the essence of blockchain in the first place. I guess we understood how you achieve that through the Canton Network. How do you achieve that through other tech, and what type of technology privacy approach you will take for Ondo?
So I think at Ondo, because our entire mission really does stem from access, right? People being able to access new financial products, people being able to, and access is not just buying, right? It's like being able to use them. It's being able to build new financial products on top of these atomic rails. I think in the interest of that, historically, we've always taken the approach that we need to be just where the users are, right? And so to the degree that users demand private blockchains like Canton, we will be there, right? To the degree that they demand interoperability with things like Railgun or Tornado Cash or whatever, we will do what we can, like within legal boundaries, to participate there, right? I think what you're starting to see is it used to be this like very black and white distinction between privacy and transparency, and now you have like very good smart contract level control over privacy across many different chains. You have all these interesting tools like near intents that allow you to use private assets like shielded Zcash on public chains like Solana, right, and seamlessly interoperate with them. I think that extra level of customization is actually what's needed, right? Because historically, with chains that tended to emphasize privacy, it was sort of a red flag to anybody watching, right? If I'm buying Zcash and shielding it, I'm always worrying about like, well, does my exchange see that, right? Does my regulator see that? If I'm going to report taxes, do they now know that I'm like a privacy advocate, right? And so even just by like being there, it's a little bit of like a tacit acknowledgement that like I might be doing something I don't want people to see. And in, in our modern world, we have this like trap that people fall into, which is like, if you've done nothing wrong, you have nothing to hide, right? And so I think with a lot of tools, we need to switch privacy on by default, right? And so if you're going to be active on Ethereum, you should be sending things through Tornado Cash or Railgun. If you're going to be active on Solana, you should be using similar tooling there. If you're going to be active as an institution, you should be working across all these different islands such that you're maintaining a base level of privacy as the default, right? And I think with better wallet infrastructure, with better exchange infrastructure, it becomes more normalized for the rest of the world to just have privacy by default and selectively disclose like as needed. And I think that's going to really change the game in terms of how people actually interact with these things. And it's not, in a lot of cases, it's just obfuscated through block explorers, right? I don't know if you guys have ever tried to read soul scan, but it's pretty bad. And today there is like a level of like sufficient obfuscation by just like the block explorers being difficult to use. But with AI, it's going to be completely different, right? We're already seeing AIs that have the ability to read the chain, parse smart contracts, etc. And so it's only a matter of time before we have some kind of like crazy event where everybody looks at each other and says, wait, all of my information is public. Oh no. And then at that point, I think as a space, we will shift by default toward more private solutions. But I think it's going to be, for us at Ondo, it really is about where the users are.
Yeah, I actually really want to echo that. I mean, it's so interesting what you say, and it's so important. The journey of Canton Network, as I said previously, actually is the result of the work at Digital Asset. And just looking here in Hong Kong, some of our clients consist of the Hong Kong Stock Exchange. So we digitized the northbound Stock Connect process, so essentially tokenizing all of the assets going through the northbound Stock Connect into China from international investors. And we have been throughout our journey. We closed that deal when we were just doing smart contract deployment. This is on a database. It wasn't anything blockchain related. It wasn't distributed ledger technology related. And even at that point, the importance of being able to implement something new and something revolutionary required privacy at its most kind of core function. Being able to outline who sees what, when they see it, and which legal entities are required to see it in an atomic and scalable way was something that we saw very early on as being incredibly important. Again, in Hong Kong, one of our clients include HSBC. We digitized their tokenization platform, HSBC's Project Orion. And again, this enabled them to be able to create these granular controls around who sees what, how they see it, but it doesn't prevent them from being able to extend it out to additional networks. I don't know if anyone in the room was at the Hong Kong Jockey Club last night, but we actually used our technology to be able to digitize their bet proposals, meaning what was previously a much smaller pool liquidity in being able to only have win or pay bets extended across international betting partners, you now actually have 14 different bet types being able to be extended. And if you saw the number on the bottom of the screen, it's distributed ledger technology that enables this kind of cross connectivity across all these extra additional parties, members, markets that brings in greater liquidity. But you need that transparency to be able to track it from a regulatory perspective, but you need the privacy to make sure, there's no malpractice on the network either. You need to make sure that the data that is required to stay private stays private, and being able to bridge that across, as you say, that's something that the customers have driven. We're hearing from clients, okay, we want to have these private blockchain networks to be able to protect our information, but then we don't want it to prevent us from being able to not necessarily just bridge, that's not the safest way to do it, but being able to actually reinstate an asset on a different network through a validator and not just connect it through a synchronizer is something that is not necessarily just a tech drive, but it's very much listening to the market, listening to the demands from institutions on how it is that they see the future given their business practices. And I think, as you say, that's where it needs to be, and that's the way we can move forward.
Great. Ming-Chi, privacy use cases, how do you ensure connectivity while ensuring privacy?
Yes, from our perspective as application and use case builders, actually, we don't really touch very deep into the tech stack of how to enable privacy, but instead we choose different tech stacks that has different layers of privacy, different levels of privacy. For example, when we build consumer-facing products where the users cares most about accessibility and the very friendly UX, and sometimes we choose chains like Base, where we serve the audience on top of Base, on top of Solana, etc. And for certain use cases that user want to accessibility into more diversified assets, it'll be outside of the crypto world, we can potentially work with Ondo's GDM, OGM on top of the Ondo global market in terms of purchasing the Ondo tokenized assets, and which will require a higher level of permissions. And it's the same thing with Canton. Actually, one of the contributors of Asta Collective is Startel Group. Startel Group has been working very closely with SBI in terms of issuing the first bank-issued trust-type stablecoin, Japanese yen stablecoin. And for the Japanese yen stablecoin to enable institution-to-institution settlement and those kind of use cases, there could be possibilities that we are exploring to deploy our JPY stablecoin, native mint and redemption on top of Canton to enable more privacy preserved institution transaction flow. Yeah, so it's all like case by case, use case by use case choices and options.
Thank you. I also want to touch rapidly, I think you mentioned it, but I want to touch rapidly about how do you ensure privacy while making sure regulators and have access or can verify certain amount of data, and how do you ensure scalability of a private layer essentially. So keeping the privacy while regulators can still check the data in a compliance manner and in a scalable way. Matt, do you want to start here?
Yeah, I mean, I do think fundamentally a lot of this is just intractable, right? It comes down to something as simple as like, I need privacy for me and not for you. And my regulator demands privacy for me, but not for you. And you might be in a different jurisdiction, and you might be on Mars, and you might not be a human, you might be an AI, right? And I think ultimately what we're going to see is a little bit of give and take, a little bit of a compromise, like any good relationship, right? Ultimately, if these tools are useful and valuable for people, we're going to, I think, see a world where the institutions do start to demand the ability to transact across public chains, the ability to transact with sufficient privacy. And as the world economy grows more and more interconnected, as we digitize the world's value, I think it's just going to wind up being a case where we have to try our best to prevent things like financial crimes. We have to try our best to ensure compliance, but there are definitely cases where, like, very, very simply, it's not possible. And so I think we've seen over the last few years a very encouraging trend where we are starting to see institutions come to regulators like, I need this product. I can't compete on the global stage without it. And, even something as simple as like a Bitcoin ETF, right? A few years ago in the US, we didn't know if that would ever happen. And then we started to see the global demand, and we started to see just the sheer scale of the crypto industry outside the US. And our securities regulators were like, okay, we have to give a little bit here. We have to enable these products to get in the hands of people who need them. And so, 8 years ago, we were all sitting here like, we have a vision. Someday this is all going to be in huge demand, and the institutions are going to be here, and they're going to need all these tools. And then there was a little bit of like a delay function where now they're kind of coming to the table and saying, wait a second, we do need these tools, right? We do need to be able to transact in this permissionless system. And so I think it really does take these loud voices in the room, people that have the power, to lobby or to help shape, forward-thinking legislation, to go to people in the government and say, hey, like, we need this here. Let me help bring you up to speed, right? And so a lot of our efforts in the US do focus on trying to help our country create this like more modern framework around tokenized assets. It's something that we think we really need to get clarity on, or we are at risk of losing a lot of economic activity. It's very similar with privacy, right? It's going to be like people coming to the table saying, look, I need this. Let me help you understand how it works, what it does, and we can work together to figure out what's off limits, what's out of bounds, what's in bounds, and find a sort of common ground where things can be, sufficiently private without creating a lot of like negative side effects.
Yeah, I just want to add to that as well. I think it's important as well for regulators and for jurisdictions that are a little bit more kind of bearish on what it is that they want to look at within the ecosystem. It's having in production use cases. It's having things actually work on chain that are generating value as proof points. These aren't the days of POCs or sandboxes anymore. We're past that. I don't know if anyone saw the press release. DTCC has just signed onto the Canton network to do all of their US tokenized treasuries and be able to extend it out to much more global markets. The liquidity already that we're seeing in demand from actually Asian brokers, like here in the region, having so many people coming on board saying, this is something that we want to be a part of. And actually those are in jurisdictions where regulation is not as far ahead as it is in other places. And it's as a result of that needs to happen. We need to be having like in production safe private use cases that highlight that this kind of scalability and this value add can be generated without it being this like huge turnaround in regulatory kind of. We need to reduce that fear essentially by proving out that this works and there's value in it.
Pinchi, yeah, we've heard the others mention about use cases and companies they've been collaborating with. I think you've been collaborating with Sony on your network. Can you essentially expand to what was the collaboration about and how they would use privacy or scalability or even compliance tools that you would offering them?
Yeah, actually, we work with multiple parties, not only Sony. So it is not directly with Asta Foundation. It is one of the contributors to Asta Collective. Startel Group has been working closely with Japanese enterprises like Sony, these days SBI. For Sony, what we have been exploring has been building is Sonian. It's an Ethereum layer 2, built mainly focusing on entertainment use cases. From Sony's perspective, of course, they have a wide variety of business covering entertainment, covering hardware, manufacturing, everything. And from their, and also, of course, Sony Bank, which is one of the largest neobank in Japan today. And from their perspective, when they exploring blockchain use cases, it is not about only moving like most of their business on chain. It is more about exploring potential new synergies that can be created together with blockchain technologies. In Sony's case, for example, Sony actually right now most part of their revenue comes from their IP holdings because they acquired a lot of IPs in their past deals. And what they have been exploring with on top of Sony is how to leverage those existing IPs and to create more creator use cases, to encourage more creators to build on top of Sonium, to leverage the blockchain technology, to leverage all the incentive structure that's native to the crypto ecosystem. To encourage the creators to build different kinds of arts, different kind of creator economy on top of the Sonium blockchain. And with enterprises like SBI, they have different thought. They are more close to the TradFi area. They are the financial institution. So we have been exploring use cases of building a layer 1 blockchain, focusing on RWA of Japanese assets and perpetrating of crypto assets, and also the JPY stablecoin, which will be like the one focusing on on-chain carry trade and payment use cases. So it's all very different, case by case, enterprise by enterprise. They all have different demand, and we just do our best trying to accommodate their demand and find the best synergies between the different layers. And in terms of privacy, of course, for the entertainment use cases, privacy is relatively less a concern. What people care more about is IP rights, etc. And for SBI's financial use cases, primary privacy becomes a relatively big, larger issue. But right now at this stage, we have been focusing on building the infrastructure, getting the assets issued, getting the stablecoin issued, and on top of that, we choose different tech stack as Canton and etc. to opt in to different layers of privacy for different use cases.
Right. Thank you. Well, conscious of time, I would like to hear how do you see the privacy world in blockchains in the next 5 to 10 years, Matt? Give us a crunchy future view.
A crunchy future view. I think it'll be like HTTPS, right? I think it's going to go toward basically a world where the second you're not in a private mode, your wallet, your browser, everything is like, are you totally sure you want to do this? It might be dangerous, right? I think it really is just going to be like privacy by default. And I was just thinking like, it would be pretty crazy like 15 years ago if we were sitting on a panel at like a technology conference talking about, hey, do you think HTTPS is going to work? What about the regulators? Don't they need to see all your internet traffic, right? And with HTTPS, it's sort of immediately clear what the safety benefits are for the user, right? Of like not getting phished, knowing that they're connecting to the correct server that they're connecting to, knowing that like their data isn't leaking out into the world for bad actors to take advantage of. And in crypto, like all of these same things are true, right? But it's just not as like immediately clear to everyone involved that you do have like very important safety concerns when it comes to not transacting in private modes. So as we sort of wrap our heads around this, especially in the 5 to 10 year horizon, I just think everything, it's going to be privacy by default.
Privacy by default, HTTPS. yeah, you view in 5 years, 10 years?
5 years, 10 years. I mean, I think we've started the implementation for it. I think now what we're going to see is just significant more adoption to the Canton network and a lot more traffic there. Because at the moment, what it is that we need in the future, the brickwork and the foundations for it are being built now. So TPS.
TPS on Canton network. Ming-Chi.
Yeah, we still hold I think the key factor of blockchain is about having different options to be permissionless. I think for the privacy world, it's the same. We will see different kinds of technical approach, FHE, TE, ZK, shielded ways, etc. There will be different kinds of options, but based on the different types of use cases, people will choose different tech stack. For example, institutions may choose Canton, and for example, like some relatively shady gray zone areas, they will still go with Monero, they will still go with Zcash, they will still go with solutions like Tornado, etc. Yeah, so different layers of privacy for different use cases. And for some retail-facing ones, we also see like Zama, etc., based on their FHE solutions, which could really be helpful in terms of retail-facing kind of privacy transactions. Yeah.
Great.
The title of this panel is From Parallel to Integrated, What Institutions Need to Fully Embrace Digital Assets. And we were having some back and forth about this because obviously institutions can be defined in many ways. So you have the institutions from the government regulatory perspective, you have the institutions from the TradFi, the financial institutions, the banks, and then you have the institutions from the sovereign wealth funds, pension funds, other large institutional investors' perspective. So while we'll be focusing more on 3 and a bit of 2, we do also want to give some context to 1, bearing in mind we've already discussed regulation at quite some point throughout the conference thus far. So what I'd like to start with is taking a look back at the last 12 months to see really what's changed. So last year at CFC St. Moritz, one of the biggest roadblocks discussed was regulation. So I don't want to labor the point too much, but just taking that into account, so the changes in regulation, what have been some of the key moves since we were here last year on stage that have made it easier for institutions to enter the space? And I'll start with you, Paul. Maybe you could also give because I know you have some regulatory thoughts as well, and maybe just give the global perspective and then we can narrow down.
Yeah, I mean, I think it primarily comes down to trust and integrity and, who's actually checking what your counterparty is actually doing. And that's one of the reasons that, a regulatory framework or a regulatory environment is one of the most important things for any of these institutional investors when they're seeing who they trust to either conduit their assets through or to manage those assets. So, I think the biggest change certainly over the last year has been increasing noises, increasing clarity coming in the US. So whereas until probably a year ago, US was not top of list of our priorities, it's now very much become our list, top of our list of what we're looking at. And so finding a way to access that and access that market has become really, really important. So, we are regulated in multiple jurisdictions. We offer our clients across the world, different entities depending on where they're located. And we find that absolutely critical. So, yes, we are a heavily regulated organization, but, our prime and sole focus is really the institutional market, as broadly defined as you did.
And has that knock-on effect been immediate in terms of, yes, this regulation, you're like, okay, that's great, that's going to be a pivot for us to move more into that market? Or is it something that you've seen sort of building up in anticipation?
It's definitely been building up, and we've got clients also. For example, Europe. We're regulated in Jersey, which has been completely satisfactory for a long time. But now we're finding that clients actually need a MiCA license as well. So some of our clients are insisting on that. So again, we've had to extend licensing into Europe, where previously we hadn't to do that. But that's actually a good sign because it means that more organizations within Europe are actually considering accessing the market and asking participants like us to go and get licensed.
Exactly. I know we have a number of different viewpoints on this panel, so I want to extract all of those. What have you seen, and maybe we'll go next to you, Fernando, about the key moves in the last 12 months that have enabled more institutional access?
Absolutely. I think what the changes in the US have been critical. I myself am based in Tokyo, Japan. For many years, Japan and Singapore were, I would argue, some of the most forward-leaning jurisdictions, but they were still waiting for the big banks, the big asset managers in the US to make a big move. So even though, again, you could try to test some things in Japan, Singapore, Hong Kong, you name it, at the end of the day, most players putting that on a sandbox, right? Or they were doing pilots, right? But they were not quite ready to do crypto or detail from a profit center. But now that we have the biggest capital markets in the world, which is the US, right? Start to be more receptive to this tech. And now we have access to a market that can give you the economies of a scale that you need to justify a different approach, right? So it was quite eye-opening to see many banks and asset managers, not only US, also outside of US, start to move their initiatives from a cost center, from the innovation or R&D departments to a business unit. I think that is the big change, right? So now those who are driving crypto have clear KPIs. Whatever these are based in revenue, know how many POCs of project we've done the last fiscal year, right? So I think what makes me quite optimistic, right? That this time around, the mainstreaming of digital and blockchain is going to happen.
And that's a good segue to you, Carl, given you have the asset manager perspective as well. What have been some of the key changes to enable more in the last 12 months?
So I think the regulatory certainty is there, or at least has been there for the past year, and I'm talking about 2025. This was the reason why things were not moving before that. Now, what's been happening, and we've been in the UAE for the past 2 years, regulated since last year, so really close to the allocators in the region. What we've seen happen in 2025 is getting into crypto, but the TradFi way, right? So what's happened is most of the big allocators, and if we're going to talk about sovereigns, and we're going to leave banks and financial institutions aside, so allocators that allocate their own capital today got into crypto by the TradFi way by using the ETF, right? So that was their first step into the game, and the reason for that is very simple: is easier to implement, right? They deal with instruments they understand. There's no additional operational work that's required. There's no additional knowledge within the teams that's required. So that was the first step. And I'm going to make a parallel with the VC world, startups and that are trying to partner with big institutions. In this case, it's crypto trying to partner with those big institutions. Things take a lot of time, right? I think there's only one bank in the UAE today that offers crypto trade, or one, I would say, legacy bank that offers crypto trading and custody, which is Rack Bank in the UAE. The others haven't moved. They are moving, but at a very, very slow pace. So that's the first step of that adoption. We do crypto, but we do it in a way we can operate easily. And we'll talk about what are the next steps that need to be done later.
Yeah, on the very positive side, what we've seen this year, I agree with what the fellow panelists are saying, is that many more of the traditional firms are asking questions and are actively looking to be educated. Of course, they come sometimes from quite far, right? They've got to really do this setup if they want to go beyond the ETF, but they are starting. They're looking for secure, trusted counterparties to work with, and we've been Asia's safest for a long time now, so we get a lot of that demand. Also, and speaking of demand, we see a lot more being driven from a demand point of view rather than from a supply point of view. So many of the providers, like for example here Franklin Templeton, but many others as well, they look from a demand point of view, what can we offer, and are really looking at, okay, how do we also capitalize on this tokenized world, and can we get into this world. Another example is we launched structured notes in 2024, and we're distributing those to other private banks, and we really see the demand for that, for example, pick up, and that's a testament to how banks have evolved from not being willing to offer this to their clients at all to now being really willing to step into that.
When you say the supply is not there, can you go into a bit more detail on that in terms of what's missing?
Oh, just the bare fundamentals to start with. They've got to set up custody. They've got to set up their compliance infrastructure. They've got to understand the market. They've got to oftentimes traders. Sometimes they've got to understand 24/7 and how that's going to work for them. Many that are more traditional come with demands that are very common in the traditional world, but are not necessarily there in the digital asset space. So it can even be a question on how do I buy a stable coin? I've had that question. If they want to trade, and what's the difference between US dollar to BTC liquidity versus stablecoin versus BTC liquidity? So you see a large variety between the different players, but I think the big difference is we weren't getting those questions necessarily in 2024, and in 2025 we definitely were.
Yeah, that's interesting. I'd like to come back a bit more into like the ETF point and then how we're evolved from that. But I know that 3IQ as an asset manager, when we were looking into the space, like one of the issues is for the sovereign wealth funds that they just didn't recognize any of the counterparties back then. And that obviously has changed quite a lot in the last 12 months, but it was just too many things for them have to go through the due diligence of before they could even get to that point. I actually want to reference the slide and talk a bit more about some of the hurdles that we're seeing, but Anthony had the slide up before that said the survey showed that most people in this room, so people in the digital asset space, thought that liquidity conditions in digital asset markets were unsuitable for institutional investors because there's insufficient depth and volume. Agree or disagree? And clarify your answer.
Yeah, no, I think that it depends what you're talking about, right? So I would agree that DeFi is probably unsuitable for institutional investors. But I think that certainly in Bitcoin and the Bitcoin derivatives market in particular, there's ample liquidity. Now, it depends on who you're talking about. If you're talking about very large pension funds, very significant multi-billion-dollar allocations, then of course, yes, ultimately even Bitcoin gets stretched. Certainly the spot markets can't really absorb that. But in the derivative side, absolutely. I mean, there's great depth now in the derivative side in Bitcoin. As soon as you go down into altcoins, then liquidity tails off pretty rapidly outside the first 3 or 4. So after ETH, Solana, then but if you're looking at markets where there's if you're looking at coins where there's an established options market, then yes, there is enough depth for institutions to be involved. But again, that's not a huge proportion of the alts market, but still Bitcoin is dominant across the asset class. So I think that yes, it is a suitable Bitcoin, and Bitcoin derivatives are suitable for institutional investors.
You want to comment when it comes to tokenized securities, not necessarily things like Bitcoin or native tokens. I see a chicken and egg issue, and you have many asset managers tokenizing share classes, or in some cases the whole fund. But when you go and talk to those organizations, you realize that the sales team would rather sell that fund in a traditional format, right? Because they see the demand there, and the guys who are doing tokenization, they don't have someone on the sales side who is actively pitching that product, but they are not incentivized. Now they are getting a bigger bonus in many cases, especially until this changed in the US, right? Because they were doing all these things as pilots, POCs. So you have innovation on the product side, but there's no one actively selling the product itself. This is finally started to change because, as you said, now even with Chainlink, as an IT vendor, we get approached by corporates who want to know, where can we buy a tokenized money market fund? Where we can buy a tokenized mutual fund? We are pointing them to asset managers. Like in many cases, and I will not mention any names, right? Those asset managers don't have a sales force that is actively pitching the tokenized version of their own product. Right? So it has a chicken and egg issue, but they just in the US, I think, are going to make that chicken and egg issue kind of disappear. But I think there has to be a change at certain, asset managers and other product issuers, where the sales force is incentivized to sell the tokenized version of the product. It's not happening today.
That's interesting. It sounds like the product's there and the buyer's there, but there's just not the people in the middle or the communication to actually sell it. So, people have been saying for a while the institutions are coming, and I haven't, as someone who's been on both the sovereign wealth fund side and the asset manager side, that hasn't really been entirely true. I think there are still some roadblocks, and I know all of you are speaking to the large institutions quite frequently. What do you see as some of the roadblocks still? And then we can talk about the exciting innovations that are happening in the space. And maybe, Evie, we start with you, because I know you have a broad spectrum.
And the roadblocks, well, I think the practical sense, still many need to come up, but I think when we think about institutions, definitely traditional institutions, taking a step back, it takes a while for an institution to implement something. I already know what we're going to build in the next 2-3 years. So it's oftentimes decided up front, is much less dynamic than in the startup space, right? So these things take a bit more time. Also, the robustness of what is being built is definitely taking into account when you start looking at large institutions coming in. But you have smaller institutions that can be more nimble, that can be more flexible and come in sooner. And people are looking for education, as I said earlier. So I think that's quite positive. And you have some players like ourselves who can actually offer you services to get started, and you don't need to do the whole learning journey for 5 years before you can get there, right? You can get institutional gate custody, you can trade on a regulated bank rate exchange, you can do the derivatives and options through us, and we will take care of the credit risk that comes with that, and you're facing DBS. So there are definitely partners that you can partner with across the world, a few, where you can solve that, and that's what we're doing very actively with a number of institutions. I also think it, on your previous questions, yes, there is in Bitcoin there is depth and volume, but it is 24/7 depending on the timing in the market. It is not as deep as you might want it to be at all times. And so with more institutions coming up, it will improve, but it will be a gradual push.
And Carl, what about you also? Because I know, and I have to commend you here because we're both based in Abu Dhabi, and you do so much in terms of the education in the space to bring people up to speed. So firstly, thank you. Secondly, how have you seen like the feedback from investors change from your side?
Yeah, I mean, I think things have changed, maybe not as fast as we would like, but I think it's happening, and we see it. You and I see it on the ground, and I think Paul and the team at Komainu. And again, all of the work we do is also thanks to the team on the educational front. But so again, I landed in Abu Dhabi. I've been there before. I've been there since 2011. I was working on the buy side with Mubadala. And I do remember when I first took on that role, I was like, that's it, the doors are open. And would look at everyone I knew in Mubadala, we like you, Carl, but it's not the right time. And then 2025 was very different, right? Again, regulatory certainty is here. I think it's no longer an issue. It's more to Evie's point, I mean, operational readiness, right? I mean, we see it internally, even in our company, integrating AI, for example, now in everything we do in all of these processes. It has to go. I mean, you've got risk, you've got compliance, you've got cybersec. They all need to get involved. And the time to get anything implemented takes time already in a scaled up organization like ours. So operational readiness is still not there. And that's the reason why those institutions go through the route they understand. And if there was no BlackRock, they wouldn't have done it even till now. So, I mean, a compliance officer has to look at rechanging if they have clients like a bank, onboarding is very different. KYT, for crypto transactions is very different from what you do in fiat transactions. Then you've got the risk person that's going to look at it. I mean, looking at maybe volatility in the first 5 years of Bitcoin and not looking at what happened in the last 2 years. So really changing those frameworks, operational 24/7. TradFi doesn't operate 24/7 today. Right? You go in the office at 9, you leave at 5, and on the weekend you're off. So these are all roadblocks that hopefully we can help overcome by building those solutions. Custodians are there now; they're institutional grade, bankruptcy remote. They're backed by big balance sheets. I mean, we see Zodia as an example, and again, not naming, but Standard Chartered, Zodia Custody. The reason they're successful in the UAE now is because Standard Chartered is backing Zodia Custody. You've got a big balance sheet, so you're comfortable with dealing with that. The second is the knowledge gap, but to your point, this can be accelerated. So where we are today, and I think what's going to happen this year, is there's a lot of work that happened in the background that we don't necessarily see. A lot of POCs are out for a lot of these institutions, and they are getting more and more comfortable with using crypto rails versus staying just on TradFi rails, because it's great to buy an ETF, but it's not 24/7, and a lot of things happens over the weekend. So I'm very confident about 2026 from the conversation we're having, and I'm sure you're having too on the ground. I think we will see by the end of this year more institutions holding Bitcoin directly, not necessarily going to the ETF. Now, to Paul's point, I think there is liquidity enough on BTC. But again, when you talk 1% allocation of one of those sovereigns, that's a few $1 billion already, right? So they come to you, they're like, I want to buy $1 billion. There's not many players out there that can execute properly. So you have to go to different players to do that. All roadblocks that don't necessarily, there's not integrating AI. And I do remember when I first took on that role, I was like, that's it. That door's operational readiness is 5 years of Bitcoin, and even till now. So, I mean, a compliance officer has to look at rechanging if they have clients like a bank, onboarding is very different. KYT, for crypto transactions is very different from what you do in fiat transactions. Then you've got the risk person that's going to look at it. I mean, looking at maybe volatility in the first 5 years of Bitcoin and not looking at what happened in the last 2 years. So really changing those frameworks, operational 24/7. TradFi doesn't operate 24/7 today, right? You go in the office at 9, you leave at 5, and on the weekend you're off. So these are all roadblocks that hopefully we can help overcome by building those solutions. Custodians are there now; they're institutional grade, bankruptcy remote. They're backed by big balance sheets. I mean, we see Zodia as an example, and again, not naming, but Standard Chartered. So their custody. The reason they're successful in the UAE now is because Standard Chartered is backing Zodia custody. You've got a big balance sheet, so you're comfortable with dealing with that. The second is the knowledge gap, but to your point, this can be accelerated. So where we are today, and I think what's going to happen this year, is there's a lot of work that happened in the background that we don't necessarily see. A lot of POCs are out for a lot of these institutions, and they are getting more and more comfortable with using crypto rails versus staying just on TradFi rails, because it's great to buy an ETF, but it's not 24/7, and a lot of things happens over the weekend. So I'm very confident about 2026 from the conversation we're having, and I'm sure you're having too on the ground. I think we will see by the end of this year more institutions holding Bitcoin directly, not necessarily going to the ETF. Now, to Paul's point, I think there is liquidity enough on BTC. But again, when you talk 1% allocation of one of those sovereigns, that's a few $1 billion already, right? So they come to you, they're like, I want to buy $1 billion. There's not many players out there that can execute properly. So you have to go to different players to do that trade. And then you can use a derivatives market. Coinbase acquiring Deribit is great for the market because Coinbase is a publicly listed company. So these organizations might be more comfortable trading on a centralized exchange like Deribit now that's owned by Coinbase. So I'm very positive about this year, and I think we're going to move beyond, and we'll talk about that later, passive allocation versus active allocation in this space.
Maybe one comment. You mentioned custodians. In the early days, people thought that crypto was going to disintermediate some of the traditional players in finance, but I would argue that custodians like Komainu or Signum will actually be key enablers because they take on a very significant part of the operational risk.
Yeah, and I was going to chip in as well. I think the education point apart, and I completely take that because many different institutions are at different levels of their journey and how educated they've become. But the key challenges in this market, firstly, are massively fragmented liquidity. So you've got multiple exchanges. So any TradFi organization looking in sees a plethora of different counterparties. First question, how do I deal with that? Next question is, even if I do get my head around that, how do I deal with my collateral requirements. So if I'm trading on these venues, how do I make sure I have the right collateral in the right place at the right time, right? Because again, it's 24/7. None of these TradFi players are set up for 24/7 collateral movement. Most of them are on T+2. So, you know, that is a very real change in mindset, change in operational procedures, because, you know, so what they look for, and I think, you know, I agree, I think DBS is ideally positioned for this, you know, huge balance sheet player, you know, great credit. So that's another important factor, but also being able to offer a range of solutions in a one-stop shop is what these institutions want. They don't want to have to go to set up multiple accounts on multiple exchanges and deal with all that hassle. So again, you know, we as a custodian, but offering services on top of that, that's exactly what we see ourselves as. We see ourselves as providing a gateway to these organizations to be able to get their head round trading on multiple venues while still keeping their assets in custody. And that's, you know, that's our USP. You keep your assets with us, we look after them in secure custody, and we mirror those assets on exchanges. So you don't have to pre-fund any of your transactions there and take the credit risk of multiple counterparties. We think that's, you know, a game changer in the market.
It's a really great point about the operational risk, because I feel like what used to be keeping investors on the sideline was like that reputational risk. They didn't want to be in the headlines. Now I feel it's more moved to the sort of the operational, or the headache risk, or the risk that comes with it. Because, you know, people think of like digital assets as an asset class, but in reality, like, it's an entire market. Like any piece of alternative allocation that you can think about, like private credit, private equity, you know, commodities, like all of that could be digital assets. So I think people almost get overwhelmed with that. So we need to make it as easy as possible for them to actually enter the space. And it's not easy, to your point, Evie. Like it's very fragmented. I do want to talk about in the last 15 minutes, just look at, for investors that have made the move, and, you know, many via the ETF, for example, now that they're in the space, they're comfortable with doing more. What are some of the innovations that we're seeing in that space, whether that's yield, whether that's active management, hedge fund strategies, collateral management? Would love to hear about some of the innovations now, or what we're looking to see in the future. And I'll start with you, Fernando.
Yeah, absolutely. Let me focus on tokenized securities. For many years, we've been focusing on operational efficiencies. You have a shared ledger, a single, you know, a golden record. You don't need to reconcile. You can have cash and the security itself on chain, allows for programmability, you name it. But in many cases, that is not enough to justify the investment of coming up with new operating procedures. Why take the leap of faith if there's only downside? And I think the focus now is shifting towards utility, value. Why would someone hold an asset in a tokenized form factor? If they can use that tokenized, let's say, fund, and send that over to a DeFi pool where they can borrow stable coins against it, or they can get additional yield, or if they can take this tokenized fund and send it to a prime broker so that they can then trade commodities as CME. Now, all of a sudden, you can do more with that asset. It's not just buying it, holding it, and eventually selling it. You don't need to sell anymore. You can get more out of it. Collateral utility is one of them. But I think Web3 has shown that once you become an asset holder, you should be entitled to get yield out of it. That has a value. Why wouldn't you be allowed to use that as collateral to other transactions, right? I think that's going to be the key unlock and one of the biggest sources of innovation. And that's, we as Chainlink, we are focusing on that.
Mm-hmm. So let's go more into extracting yield from, you know, and whether that's tokenization or through other means. Maybe Carl, you want to talk about what you're seeing in that?
Yeah, I mean, from our standpoint, I see more that not really innovation, but more a natural evolution of, and again, a repeat of what you've seen in TradFi, maybe in the early days of hedge funds in the 80s. Investors got allocated in a beta exposure, either ETF or even Bitcoin directly, which we are seeing even at the institutional level if we talk about sovereigns. The next step is once you hold that in your treasury, a treasurer will say, okay, I mean, I'm holding that asset. how can I generate yield? Can I generate yield out of it, right? If I hold dollars and I place them in a deposit to the bank, I'll get a certain percentage. And that's the conversation we're starting to see, maybe less yet at the big institutional sovereign level, but more at the B2B2C. So banks, private banks. Last year, we announced a partnership with a Swiss bank that offers custody of Bitcoin and have been doing so since 2019, that offers lending on Bitcoin. And their clients were like, well, next for us is we want to generate yield, right? You charge us for custody, you charge us for lending. How can I generate yield? And the fact that, Swiss regulated traditional bank gets more and more comfortable, and that's because the demand is coming from the client. I think a lot of that is going to happen this year. So Bitcoin yield is a big topic across every single player. May they be digital asset treasuries, may they be Bitcoin miners, may they be sovereigns that hold Bitcoin on their balance sheet. They want to start extracting yield because, again, to my colleague's point earlier today in one of the conversations we had, are we going to see 1,000x in Bitcoin? Volatility is coming down. You want to be able to extract more yield of what you have. Bitcoin miners are focusing more on the AI side of things and data centers and all of that. So you need to be able to generate. And I think today we are ready for that. Not just us. There's many other players out there that offer different ways to generate yield on Bitcoin. May it be like we do, at least on our side, on the option side, right? Volatility selling. That's something we do and we're very comfortable with. And treasurers like this product, but it's not a product that we offer to a hedge fund manager that is fine with more volatility and more return. So I think we're going to see more of that, and that's driven mostly by client demand. And to someone's point earlier on the panel that was saying, we hope crypto will not be left out, because again, what we see is people are comfortable with what they know. And you've got the JP Morgan that offers custody, that will offer lending and eventually yield. Will they do it on their own, or will they do it with specialized and crypto players like ourselves and others in the market?
And so Evie, with you as the one-stop shop.
I'm sorry to tell you, we did it on our own. So yes, Bitcoin yield has actually been a question. Actually, generally, yield has been a question for many years now from clients. We have to think about doing that safely, meaning to say we had all the borrow lend craze and people lost money doing that, right? So counterparty risk became much more of a topic since 2022 and that whole period. So yes, we offer the structured products, we offer derivatives on an OTC basis to the private bank and to institutional investors. More demand from the private bank, as he said, and distributing to other private banks. The choice we made was that we don't only offer it on Bitcoin itself, we also offer it cash delivered as well as on the ETFs to be able to give the optionality to the clients, and being very cognizant of the fact that not everybody can deal with physical delivered yet. For example, that's beauty of this year. The American banks, the American players have the restrictions have been reduced, so they can now start looking at holding physical Bitcoin, whereas in the past we would need to deal with them on a cash basis. So those things are, I think, very positive evolutions and a very natural evolution from what you would expect. It's a natural evolution.
Is there a risk that with a lot of the traditional, with the banks coming into the space and doing all of this themselves, that we will see less innovation coming out of the crypto native companies? Like, do you think this is going to be crowding out, or the banks will still look to that as their innovation? Like, that will be the funnel that like sovereign wealth funds go through to reach that innovation?
I think I would add, I think there's going to be a move over the next 12 months more towards, let's call it the large balance sheet providers. Some of those may in fact be crypto firms, but I think the banks are very well positioned. They tend to be more slow moving and methodical, so maybe innovation will be somewhat curtailed, but I don't think the banks are going to be massively focusing on DeFi. Again, I think they're going to be focusing on the large part of the asset class, which is around Bitcoin and the top 10 coins. So that would be my view.
So maybe adding to that, what we see is that the innovation will still be driven by startups and some of the crypto natives, but it's going to be, especially with big balance sheets, that we're going to bring us the scale. you mentioned depth of the market, and in DeFi, it is tiny. And in many cases, to offer certain services, you need the balance sheet of a bank. So I think, in a way, traditional institutions and the more crypto-native players, they complement each other. I don't think they are antagonists in any way, right? So I think we'll see a convergence. Actually, we are already seeing that.
Yeah. I would say the same. I mean, we look a lot at what is happening in the DeFi space, for example, because that's the far end, and then we think, okay, what of that thinking, that technology can we bring back as and when we build? But it's going to take us a while before we could even think of doing that. I would also want to say you're right. I think it's very positive that big players are coming in, because, for example, when you think about lending and you want to hedge your risk, I need a counterparty that can take the volume that I want to cover. And honestly, there aren't that many that can take, from a balance sheet point of view, from a credit risk point of view, that can work with. Also, I got to think about wrong way risk, right? So I've got to be able to work with somebody that's diversified. So that, I think, is also very positive when more players come in that are diversified. So I have much less wrong way risk than when I work with a very specialized firm. So I think all in all, it's positive, but I don't think we're necessary. I think both can definitely exist and should exist together.
I actually would, and I know that you have something to add to that as well. So we will come back to that, I promise, because I think the scale piece is really important. But question from the audience, what can we expect the Clarity Act to improve for institutions? How important is that for inflows?
I would say more clarity is always good.
Clarity Act, one word.
Just more clarity is always good.
I mean, again, from your perspective, and I wanted to just quickly go back on, there were a lot of talks about stable coins and payments being the big thing for this year, and I think they are. And I think this is what's going to lead to, maybe in the next couple of years, where you won't talk anymore about TradFi and crypto, right? Because all financial institutions will then be working not on two stacks anymore, but on one stack, tech. And I think Jenny Johnson was spending a lot of time talking about their IT department. So this convergence is happening because of, I wouldn't say the most boring instrument, but stable coins, which is just a digital representation of the dollar. I think that needs to happen first because the demand is there and because it adds a lot of value for all the players in the ecosystem, where we're going to get to a point where we won't call anymore crypto. I mean, it will be finance as we know it, finance 2.0 or whatever it will be. So I think we're at a very interesting segue when this happens. And on top of that, again, the Clarity Act and other regulations that are going to come up, which are necessary. If you get yield on stable coins, what is it? Is it a security or not? Once you get that clarity, I think, it will be a convergence of these two ecosystems. And hopefully we'll also see a consolidation. So a lot of those crypto players that have been in the space that have innovated and will continue innovated is like fintech and banks. Fintech will always exist despite banks being around. They innovate and then they get acquired by those bigger players, and then consolidation.
Maybe just one comment, maybe a bit anecdotal, but we are provide technology and services like privately served to many stablecoin issuers, and the big potential users on the corporate side, they would tell me, we want to use it, but we are waiting for the Clarity Act. So it's not that we've done a full market analysis, but I get a handful of clients that I can think of that are really waiting for that. So I think we'll see significant inflows.
And I also think it's not a bad thing with the delay. Like, it shows that, they are giving it the sufficient amount of importance and they want to get it right. I think they see the knock-on effect. And going back to the point on scale, it's interesting when people are like, oh, there's not many institutional investors coming into the space, but there hasn't been the scale available for them to enter the space. Like on the hedge fund side with the Addias, the Mubadalas, for example, if they want to invest 100 million, not own more than 20% of a fund, there are very, very few options. There are some excellent big players out there, but the market has been limited in terms of finding ones of scale. So
but in 30 seconds on that point, what's happening, and we're seeing it, is all the traditional hedge funds they deal with today are now entering the space and adding crypto sleeves and adding crypto managers to their offering. Because when you think about it, if you're on the sovereign or you're a risk person, you don't have to go and do due diligence on a new fund, right? You say, well, I know this big hedge funds out there, we work with them, you do the due diligence on those crypto, you add that sleeve, and then we can absorb. Because the problem we have today is capacity constraints, right? Can we trade, can we generate alpha on the $1 billion allocation? So yeah, we're seeing a lot of that now, and that comes from traditional hedge funds that are getting into crypto.
Yeah, absolutely. I know, Paul, you looked like you were chomping at the bit.
No. It was earlier on. Actually, it was more on the yield point. I was just saying that I think Evie made a very good point, which is that I think credit risk and counterparty risk are very poorly understood in this ecosystem. And particularly credit risk. So, often the yields may seem attractive, but actually look to see, who your counterparty is, who you're really dealing with. And, even if you're earning, I don't know, a 10, 15% return, does that actually reflect the risk you're really taking if you measured that in TradFi terms? Most often not, obviously, otherwise you wouldn't be being paid that yield. So I think my message would be make sure you're not the yield when you're actually dealing in these instruments.
Okay, we have 1 minute left. So quick fire, 15 seconds each. What is one thing you would like to see in 2026 in the institutions coming into digital asset space? I'm starting with you.
More players like us coming in heavy.
Moving away from beta and doing more on the alpha side of things. So we would love to see one of those big players doing yield as their next vantage point or entry point.
Fernando?
So it would be for investors to take full advantage of the utility and value that tokenization can bring. Let's go beyond just getting operational efficiencies, whatever that means.
Yeah, for me, it's wider participation of the big balance sheet players coming in and really pushing this market forward and making properly sized allocations from client assets. And DBS is leading the way on that at the moment, as far as I'm concerned, and doing a fantastic job.
Literally 2 seconds left. You guys are the best. Thank you so much. Warm round of applause for my panel, please.
Here with Stacey Warden, CEO of the Algorand Foundation. Stacey, welcome to CFC.
I'm so happy to be here.
Well, today's a historic day for Algorand. Today, you've announced that you're moving back to the United States.
I'm very excited about that.
So first, what does that mean, actually, to move back to the United States, and why'd you do it?
So I think one of the most important things is really to ask, why were we away from the United States in the first place? We are founded out of MIT. The core technology is run in Boston, but the regulatory environment has been very uncertain in the United States for many years. And so we set up the foundation to be a Singapore-based entity. And for us now, coming back to the United States is really because of the regulatory clarity and the good job that this administration has done advocating for digital assets, seeing the potential of digital assets. And we want to be part of that story, not in an excessively patriotic way, but we want to be part of that US digital assets first narrative. And it's a big market in the United States as well that we've never paid attention to. So we're pretty excited about that.
The US is about 25% of the world's GDP. It's by far the world's largest capital market, which is, of course, your background at large banks, for example, beforehand. And there's a great talent pool. It's been about 1 year since the administration took over. What do you see as the future of the United States when it comes to digital assets, and why is that good for Algorand?
You know, the United States has always had a big entrepreneurial spirit, of course, right? And as you say, the deepest and the most liquid capital markets in the world. And so we think that there are so many opportunities to, and frankly, now that there's more adoption in traditional financial markets and more awareness of digital assets, we just see enormous opportunities for bringing the things that crypto is good at to bear with the traditional financial markets. And so that means things like lightning fast payments, the tokenization of real world assets, the marriage of decentralized finance with kind of traditional financial assets. All of these are enormous opportunities for Algorand.
No doubt. You decided to incorporate, and of all places, Delaware, which is quite famous for credit card companies, among others. But why Delaware?
So we were, of course, led by our counsel, who, you know, there's an enormous amount of case law in Delaware. It's one of the top jurisdictions that you at least look at when you're thinking of incorporating, and we just felt very comfortable with the legal certainty there and the protections that Delaware offers.
This is, of course, quite a big year for Algorand. You made some major changes. Among those is you've brought in a new board of which you are a member. Can you tell us a little bit about the board that you brought in and why?
So we are doing three things together. We're moving to the United States, as you've said. We're focusing on financial empowerment and all of the different aspects of that. And we wanted a board that could reflect our ambitions in the United States, as well as the expertise that we were going to need in the finance and financial empowerment area. So we have formal regulators, we have policymakers, we have the president of a payments company for 2 decades. He was the CEO of a payments company. So we're trying to make sure that we can kind of crowdsource in this expertise that we need on the board.
And Stacey, I've got to tell you, I mean, these are names that I've recognized for quite some time that have joined the board. Are they going to help steer Algorand and its community in the right direction? I know the community is something you guys care quite a lot about.
Yeah, 100%. I mean, we have some real crypto OGs on the board too. So Bill Barheit is our board chair. He has been in crypto since the very beginning. He understands what it takes to bring developers in particular into your ecosystem and to pay attention to them. He understands what is needed out of a layer one and the growth potential for a layer one. We have Rebecca Rettig, who is part of the Solana MEV ecosystem. She can help us think about that and how we might try to construct markets around that. So we have a good mix of crypto smart, crypto native with more traditional finance native board members.
Well, Algorand became famous, of course, because you were one of the first to really recognize that traditional finance was going to merge with blockchain technology. And indeed, you know, we've seen some major progress in the United States from a regulation and policy perspective. The Clarity Act right now is potentially going to be passed in some sort of format. And you mentioned tokenization earlier here. What are you excited about when it comes to tokenization? What kind of use cases do you think could be applicable to blockchain in general and specifically on Algorand?
Yeah, you know what I think is really the most interesting thing about tokenization is actually, and a little bit overlooked sometimes in the crypto conversation, we tend to think about it from the investor point of view, but actually it's quite interesting from the tokenizer's point of view. And so in 2 ways, if you imagine a multinational with suppliers all over the world, right now what that multinational will do is they will hold correspondent banking relationships with all of these suppliers in all of these different countries. What that multinational can do now is hold their assets, and you have to, of course, provide liquidity in all of these correspondent banking relationships. But if you can hold your liquidity with your JP Morgan or your Franklin Templeton that you're quite used to, and then issue a stable coin or a token against that liquidity for these different suppliers, this is a game changer.
I mean, that unlocks enormous amounts of working capital.
Absolutely. And then that's one piece. The other piece is having collateral that can turn over more quickly so that you're not, to your point, locking up your productive assets. And then payment, crypto is digital cash. And so the idea that you can make a payment and once I give it to you, it's yours. There's not this kind of reconciling that has to happen through the banking sector. All of these things are going to be very important, and they're front and center for our narrative around financial empowerment.
Yeah, this is exactly what Algorand's been working a long time to produce. And you think 2026 is going to be the year where a lot of this comes together?
Yeah, 100%. So we have the technology, we have things like instant finality, the ability to do 10,000 transactions per second, all of these kinds of things that, the history of the chain is quantum secure. All of these things, they don't lend themselves. But if you are, tokenizing property, you're going to want to make sure that when the transaction is final, it's final. If you're issuing a stablecoin, you don't want that stablecoin issued in 2 different states of the world, even for a nanosecond. So it plays to our strengths. And so we're pretty excited that all of these things are coming together in 2026.
The United States, of course, where you're coming back to, is about 3% of the world's population. It might be a large piece of the economy, but relatively small population-wise. What would you say to all the users of Algorand all over the world who are not in the United States, why this is such a good move for them?
So we're not going to abandon our community across the world, of course, but the more we're talking about financial empowerment and the better we get at it and the more scale that we can achieve on it, who that is going to help is our ecosystem, say in India, everybody that can now avail themselves of these tokenized products that we're going to be able to build with, so that you imagine yourself, if you're somebody living in a country that doesn't have a good macroeconomic policy, the ability that you could in your own wallet hold an asset issued in the United States, a US dollar stable coin, or a tiny sliver of a money market fund, that you can have some protection from macroeconomic volatility in your home country. All of these things are going to be very good for you.
And I've got to finally ask this question. I just saw you on stage with Jenny Johnson, the CEO of Franklin Templeton, one of the world's largest asset managers. It was a remarkable interview. And she seems quite bullish about crypto. So having had that conversation directly on stage, what do you want to go and tell the Algorand community?
I want to tell the Algorand community, first of all, that I was on stage with Jenny Johnson. How great is that? But there is so much potential still in crypto and in digital assets, and we are absolutely here to take advantage of it and to lead in finance and financial empowerment where we have the most strength.
Well, congratulations on the move back to the US, the new board announcement, and the narrative that you are well achieving.
Okay, thank you so much, Sharon.
Thanks, Stacey.
When the doors close.
Yes, wonderful. Thank you. I guess just to clarify, so we are talking about RWAs, which means traditional assets, actually real world assets. So we're talking about funds, bonds, credits, nothing else. And we're putting this into the context of tokenization. So we're essentially talking about the promise of faster settlement and more efficiency, as well as also potentially new distribution channels. So this is the context for now. We're today going to talk about whether this promise also translates into institutional demand, or whether we're still more talking about experiments, really. So I'm delighted to be leading the conversation. Thank you for the introduction. And I'm joined today by Patrick Hennes from DZ Bank. I'm going to take a liberty and sort of situate you in the RWA stack. So for you, you're sort of like the banking and custody layer, right? So institutional interest in RWAs either comes into fruition or not. So that's where it stops with you. Then we're sitting in a different order now. Fine. Artem Tolkachev from Falcon Finance. So you focus on structuring RWAs on-chain, where product design often also determines whether institutional demand can actually become practice. Yes? Okay. Just, this is also for me an exercise. So Mykolas Majauskas from Bybit, you bring a policy and market structure perspective, looking at how regulation, access, distribution can all shape who can participate in tokenized RWAs. Yes?
Happy to do that, yes.
Okay, and just generally, just so also for our audience, so you know who's talking and about what. Then we also have, we have Michael Manning from Ava Labs. So Michael, you represent the infrastructure layer, working with institutions that are moving from experimentation to practice. Yeah. And then we have Roger Baston from Franklin Templeton, and you bring the perspective of the global asset manager that already has tokenized RWAs in production. So not just theory. So from this, we'll jump right in and we'll start with institutional demand for RWAs and where this is coming from. So Patrick, if we can start with you from the banking and custody side, what does real demand look like in practice? And at what point does interest turn into something that a bank is willing to also put on its balance sheet?
Yeah, the balance sheet question is not what we are talking about currently inside a bank, to be really honest on that. What we are looking at, and we have to, in fact, we have to split the demand in two angles. You have a demand on the asset manager side, so I'm coming from the asset servicing industry, and you have an internal demand in the bank itself. So I would say on the asset manager side, the demand is still shy, to be honest, because they don't care, in fact, where we are running their assets on. But when we will provide them with the infrastructure that will use this new technology to allow tokenization, to allow digitalization, then we will generate the demand on their side. So what we are currently doing in our bank, and it's in the whole industry in Luxembourg, so banking side and asset servicing side, we are working on the infrastructure. So it's an internal demand, in fact, that we are answering. So what are we doing? We are looking at the infrastructure, the whole value chain of asset servicing, and we are looking what can the technology bring us to generate more efficiency, to automatization of processes, and to offer then a new offer to our clients. And then the demand from the asset managers will come. Of course, we have a demand. So everybody is talking about money market funds. So the tokenization of money market funds is a real demand. But we could make a link to the panel before with the stable coin. It doesn't make sense to tokenize a money market fund when we don't have the stable coin as a payment rail. That's the truth.
So you're going to create demand. So Roger, from the asset management perspective, do you also think that demand comes from the inside and then it will follow?
Well, there already is demand for real world assets. You're defining real world assets as something that's going to ride on the blockchain rails, but we already know that there's demand for the real world assets. The question is the proliferation of digital wallets inside of the institutional community. We already know that in the two large camps on planet Earth that we see at Franklin Templeton, those that have digital wallets and are adopting them. And by the way, we know that digital wallet adoption is running faster than adoption of the internet, even 25 or 30 years ago. And then you have the want wallet community that, you know, that digital wallet, those that have digital wallets and are adopting them. And by the way, we know that digital wallet adoption is running faster than adoption of the internet, even 25 or 30 years ago. And then you have the want wallet community. So we already know that there's hundreds and hundreds of millions of digital wallets, but they tend to be held by individuals on these platforms like, you know, Binance or Coinbase or Kraken, whatever the case may be. And so they're the ones that have the digital wallet. So the question is really about the proliferation of digital wallets into the institutional community. Absolutely, there's demand for RWA. There's absolutely demand for tokenized money funds like Benji. And we're seeing that and we're living that every day. And that's because those institutions that do have digital wallets, and those would be bestly defined right now as the kind of the crypto native private funds or hedge funds, you know, that have active strategies inside of the crypto asset space specifically, are wanting to use something that gives them more economics on their derivatives trades versus no yield stablecoins. And so they are asking, how can we improve that? And we want to improve that trade and that experience, that economic outcome. And we want to use a tokenized money fund rather than just a stablecoin to do so. So that is where we are living and realizing huge demand already for tokenized money funds and RWAs. We're seeing that. It's just a matter of how the rest of planet Earth and the communities begin to get digital wallet adoption into their hands.
Can I ask a question? You said something that was really interesting, which talks to the really insular nature of our industry, which is, we've called this thing real world assets. And your response was basically, well, you mean assets, right? It's like it only becomes real world assets if you're used to dealing with something that's decidedly not real. So my question though, back to you on this, yes, there's demand for treasury funds. What's the incremental demand for a tokenized treasury fund?
The incremental demand for a tokenized treasury fund are those that want to enjoy the better utility of the money fund. And what do I mean by better utility? The better utility means it moves exactly like a stable coin, instantaneous transferability. If you're really operating on chain, the vast majority of the tokenized money fund experiences that are happening out there in the marketplace right now are digital twins. So they're not really operating on chain. You know, we're in a little different position on that with Franklin Templeton. Benji actually operates on chain because we went through the brain damage with the regulators to get that to happen. But the other utility that we have brought with Benji is the idea that we have taken the 24-hour clock, taken it to a 1-second resolution. And if you own Benji for any hours, minutes, or seconds of the day, you're going to get that accrued interest. So if you think about the application as collateral inside of the ecosystem where these things move a lot, as long as you're holding Benji for any period of time, you are going to make that money. Your money is going to sweat for you rather than being idle or go into the banking system. The banking system is going to make money for you.
Yeah, and I think, by the way, that second by second accrual of interest.
You're going to run that with Franklin Templeton that are really operating on instantaneous utility means that mobility, incremental demand for a tokenized treasury fund. The incremental demand for a tokenized treasury fund are those that want to enjoy the better utility of the money fund. And what do I mean by better utility? The better utility means it moves exactly like a stable coin, instantaneous transferability. If you're really operating on chain, the vast majority of the tokenized money fund experiences that are happening out there in the marketplace right now are digital twins. So they're not really operating on chain. You know, we're in a little different position on that with Franklin Templeton. Benji actually operates on chain because we went through the brain damage with the regulators to get that to happen. But the other utility that we have brought with Benji is the idea that we have taken the 24-hour clock, taken it to a 1-second resolution. And if you own Benji for any hours, minutes, or seconds of the day, you're going to get that accrued interest. So if you think about the application as collateral inside of the ecosystem where these things move a lot, as long as you're holding Benji for any period of time, you are going to make that money. Your money is going to sweat for you rather than being idle or go into the banking system. The banking system is going to make money for you.
Yeah, and I think, by the way, that second by second accrual of interest that you offer really is not something that everybody's made use of. Like BUIDL, I think, accrues end of day. So I think that really is a good example of leveraging the increased functionality, but I don't think it's done widely yet.
Can I, for the sake of entertainment, disagree with my colleagues here?
Please go ahead.
Thank you. So I've been traveling from conference to conference a couple of years on crypto, and I've been hearing about tokenization, that how it's going to be disrupting the world and you know, disrupting the global financial markets, and especially original crypto companies talking about that, you know, they're at the table and they you know, deciding the future and disrupting the traditional finance. And the reality is that they're actually not at the table, but on the menu of traditional finance, and traditional finance is just slowly eating them up. And if you look at the tokenization of what we've seen over the last 2 years, and lots of conversations, you know, great insights, very smart people. The total tokenization, what, 30 billion, right? 2 years of hard work on panels discussing about these things. And, you know, if we compare that to the global equity market, 130 trillion, so 0.0%, 0.02% or something like that. And, you know, then we talk about, you know, what's coming next, and, you know, oh, you know, we've got stable coins, but you need stable coins to settle, but no private issuer is able to settle 100 of trillions, and they will not be able to settle 100 trillions because only government issued stable coin or digital asset money is able to do that, and governments are not doing that. So when we're talking about the scale, yes, there's great demand for the money market funds. There's a fantastic demand for the collateralized, tokenized collateral. There's a great demand for private credit to reduce the opacity. There's demand for the stocks, but stocks are not tokenized, they're not real assets. And it's a great job what Kraken is doing, Robinhood has been doing, but at the end of the day, they don't represent the real ownership. They're not paying dividends. You can't vote. They're not real. And it's great if we want to have it for retail for a little bit, but if we want to have it scale, it has to be real, number one. It has to be properly settled with global digital money issued by institutions, because no private is able to do that. And governments have to pull finger out of their mouth and do something about it. So in Europe, we have conversations about building sandboxes. It's a great thing, but US is going just straight for the beach while we're playing in the sandbox. So I think that there's a big gap in terms of what we're thinking and what we're excited about and what is actually happening right now in the world with the tokenization of 2 or 3 years excitingly talking about it. So I think it's about time we get real and talk about the things that we actually need to do to solve the issue.
So we have demand, as we've established. There are also products, and they tend to also fit what institutions want. And it's just a lack of regulation or appropriate regulation that's breaking down this equation.
So I think that there are several elements that I mentioned. First is legal clarity. So we don't have legal clarity in Europe, and specifically, so we had a pilot regime, again, sandbox pilot regime with limited scope of products that you can use, cap on the volume, and the time of the license that you can operate. And even now with the adjusted program that's about to be put in place, you still got all the same things. You've got caps, you've got scope, you've got term of 6 years. It's not going to work. If we want to compete, especially in Europe with the United States, which is actually making significant steps. So what they've done with the stable coins, they will do the same with the tokenization. In Europe, if we want to go plow ahead, there's big competition. So regular clarity must be there. Legal ownership, the true ownership. So if we tokenize stocks and we want the exposure to the Tesla stock, not the Robinhood UAB in Lithuania, we want the real asset there. We want to be able to vote to get dividend. So we want to scale it. That's what's going to happen. And we need settlement, global proper settlement. And for that, again, we need the government involvement. So I believe that we're really far away from real scale of institutional use. But yeah, some good conversations are taking place.
I think, Artem, you've been also itching, and Patrick as well. I know.
I quite agree with the skepticism of Nicholas, to be honest, except maybe the stocks part. So we're working quite closely with X stocks by Kraken, and what I've seen, they grew quite fast. So they launched like 6 months ago. Now they have more than 200 million in assets. They're paying dividends. They're doing the share splits and so on. And I'm a lawyer by my background, so I spent a lot of time trying to build as much sort of a straightforward ownership-first model in my previous days. And what I realized that users, in most cases, they just don't care about actual ownership of the particular stock. What they care about is usability, is their availability to use it as collateral, to deal with it in a decentralized manner, not just like this pure ownership stuff. But regarding the skepticism, I from my point of view, I think there is no actual institutional demand, if we're speaking about TradeFi, to real world assets. We can discuss the size and so on, but honestly, what's the point for the TradeFi guys who's already operating under the quite clear rules, who's already have access to like treasuries, money market funds, structured credit, and so on? What's the point adding some complexity, paying a bit more basic points for the additional infrastructure of tokenized assets? Because despite all the promises of disintermediation, usually tokenized real-world assets doesn't remove intermediary from the process. In the best case scenario, we're replacing one transfer agent for crypto-friendly transfer agent, but in the most cases, we're just adding additional intermediary into the process. And I think it's quite clear that traditional TradeFi players, they don't have clear use case to use tokenized real-world assets. Crypto native users, crypto native institutionals, for sure, they're already operating inside the crypto ecosystem, and it's a quite straightforward use case for them to deal with tokenized assets. And I think the biggest pain is with retail. Retail still don't have a proper sort of access to tokenized assets, tokenized real world assets, because most of these assets are gated. Benji is doing pretty good job, but it's only in one jurisdiction. I tried to open an account with Benji for Falcon, and it was like, yeah, so it's quite complicated, I will say. Yeah, and I think retail is the most underserved category in all this real world assets topic. But unfortunately for now, most of the real world assets are operating under whitelist, under gates, and so on and so forth.
But don't get me wrong, I'm not skeptical. I'm just saying that we're not doing enough. Tokenization of real world assets is a great thing because it makes it cheaper, quicker, more simpler, and you can actually do so many more things, providing global settlement, 24-hour access, liquidity. You can manage cash easier. You can actually do proper banking operations with collateral being tokenized. So the opportunities are there, but it's just that I'm getting the feel that we're talking more than we're actually delivering. And that's been happening for quite some time.
And I think that's also exactly what we're trying to establish here. So nobody's doubting the potential here. We wouldn't be sitting here if we didn't believe in this, right? Patrick, I know you wanted to say something, so please go ahead now, because I know everybody wants to say something.
Sorry, Anne-Sophie, we are no longer in the script.
We are, by the way, ruining the script entirely.
But it's a great discussion, and I agree with everybody. But we need to come back a little bit to the basics. And I am here the old banker in this group, not only because I have gray hairs, but we need...
I dye my hair.
But we need...
I've had a lot of work done.
We need really to come back to the infrastructure, in fact. You are all right with what you say. I like the wallet discussion, because the wallet is something very important. If we want an adoption, and I would even say more than a wallet, I would advocate for a digital custody infrastructure. This is absolutely what we need, because I am also a member of the Banking Association in Luxembourg, of the Investment Fund Association, in these technical digital groups. And we are all talking about tokenization of RWAs. For us, it's investment funds, okay? But I told to the guys lately in a meeting, we don't need to talk about tokenization if at the beginning of the value chain, our investors still need to fill in 30 pages of an application form. Then we never create a demand for a tokenized product. So the first thing to do is to put the digital identities on chain as well. And then we can provide the tokenized products, and then we create also the payment rail through stablecoins. But we need to create the digital identity.
I think more broadly, and I guess putting the microphone in your hands again, yes, I'll get to you guys. Maybe Roger, while we're at it, what asset classes or what types of assets or things do you even think make sense to tokenize now in this context? Also digital identity or something else?
I absolutely agree with the digital identity. One of the problems of the asset management business and the kind of the general investment business is that there's no way for us. Another asset manager has a KYC AML process. I'm not indemnified for using that process. I have to have my own. That risk is not something that's shared across the industry in a way that creates a whitelist environment where it's easy to get on and off. This idea of the Web 3.0 wallet, where you own the information and you share it appropriately, is absolutely a trend that we'll continue to see unfolded across. And I absolutely believe with the custody business. But you have to think about the path that we're on when you think about, well, there's nothing that's really been happening we're promising. In the US, it took the elimination of SAB 121 accounting recommendation by the SEC to unlock Bank of New York, State Street, Northern Trust, Citi to begin to build their digital custody business. Now, the things that they're still challenged with is they think that the digital custody applies to about, maybe 5, maybe 10 different tokens. But the trend that you're seeing is we know we're going to meet customers in this Web 3.0 wallet. We know that there are hundreds and hundreds of millions of wallets out there. That's a new distribution channel for us to bring product to. At the same time, Manufacturing those returns with raw materials means that the raw materials have to come to us in tokenized form. And we know through the announcements that the NASDAQ and NYSE, and we're super familiar that the largest issuer of securities on planet Earth, the US Treasury, who doesn't need permission because they work for the president, are going to be bringing tokenized treasuries onto the planet. So the entire ecosystem that we deal with as an asset manager, both delivery of product and then the consumer of the raw materials, is changing right in front of our very eyes. So we may be skeptical about the pace that we've had so far, but all of these things are hurdles that are clearing weekly, monthly, right in front of us. And if you're not staying at pace on that, you're going to have more limited opportunities. So I think you have to just step back and see where the impediments have come and how much has changed even in the past 12 to 13 months.
And I very much agree, especially if we, again, look at what is happening in the United States. So we have the most sophisticated market, Europe, which came out first with a MiCA and a gold standard. And then we have US, which went through Europe 100 kilometers an hour, just passed, with all the legislation, with the motives, with the great power of change and innovation and institutions, with especially with the stable coins, creating additional demand for the treasury to deal with the fiscal issues in US. Super smart. And also using the stable coins as a geopolitical tool as well. Look at what we've heard here on the panels as well. And you can go to Latin America and you see that US dollar stable coins are used daily for life. And in Europe we talk about crypto like a luxury good. In Latin America it's daily. People save money because of the inflation, and governments are open to have it. So United States are doing a great job, and I think that Europe should be following and realizing of what's happening. But again and again, that is not enough. And we heard examples of users having to fill a number of documents. Can I disagree? Again, for entertainment purposes. Users are smarter than they were 20 or 50 years ago, and governments are often treating them just as they were treating them 50 years ago, when they had one house, one car, one job, and no social property security to take risks. Today people take so many more risks, chase jobs, travels, cars, leasing, and they go bankrupt and they get up and do business again. So
At least in the US.
They're more prone for risk, and they're more capable of handling risk, and they better understand the risk. And we should trust them in taking them proper, sober decisions in terms of where they should be invested. And if they have to fill in those documents, they'll fill those documents in. It's okay. They're smart enough to make decisions. And it's just that sometimes governments in certain jurisdictions, they treat them like a nanny state, just as they were 50 years ago. And I think that has to change.
I'm going to disagree with that.
Thank you.
Just to back at you, right?
Just for entertainment.
Yeah, just for entertainment. By the way, I agree with everything you said. I think that we're all broadly in agreement that I think there's demand for demand. You guys are issuing. You want people to buy it. I think there's still a challenge on finding the distribution, but I don't think notwithstanding that everything you said about legal ownership, true sale, regulatory compliance, reliance for KYC, infrastructure, that's all important. But I think we've actually got a deeper problem, which is that we have not found product market fit for real world assets on chain. I think that there's often a laundry list of things that tokenization could, in theory, do better, and it's broad and it changes depending on who you're talking to. But I think I think it's worth enumerating the things that I think that tokenization does well, and I think there are four. It reduces counterparty risk, either through DVP settlement or greater transparency into the underlying, where you can cryptographically guarantee some of the constituent data. It reduces settlement time. It eliminates intermediaries, and it allows for the reduction of operating costs by automating certain processes. Those are the things that it does well. Those virtues are not universally applicable across each asset class. So I think you've got to figure out, what do you want in an asset to tokenize it? And I think you're looking for things like high degrees of counterparty risk. Trade finance is a great example. You're financing invoices. You don't know if the invoices are legitimate. If you can get a cryptographic signature of the invoice by the obligor, you've now eliminated risk. Key use case for tokenization. You want to accelerate settlement times. Well, that's important for some assets, particularly ones that are trading frequently. Less so for a hold-to-maturity bond. You want to reduce intermediaries. Well, you want to have high-cost intermediaries for that to be relevant. And what was my last one? You need to accelerate backgammon. There's another one. let's look at the assets we're now pursuing, and let's take a look at tokenized equities. That's probably the worst use case out there in my mind. In fact, I was looking at a McKinsey study that they were predicting the adoption rates of assets in different waves. They had tokenized equities at wave 3 in 2030 and beyond. Close on its heels were tokenized funds. I don't think either of these asset classes lend themselves well to those benefits. Take stocks in particular, deep liquid market, very, very thin margins by intermediaries, zero counterparty settlement risk. If you're doing high frequency trading, you've got settlement time as an advantage, but if you're buying and holding for a year or plus at a time, not a huge advantage there. We're going after that, I think, opportunistically for distribution. And I think in many cases, what we're doing is pursuing retail money with institutional analytics behind it. It's the age-old story of, sell side ripping off the dumb money on the street. I don't think that's a great use case. I don't think that scales. I think we need to be finding things where you really have honest to God utility in the assets, and the tokenization benefits, which do not apply equally across the board, apply. Cross-border settlement, where you can eliminate pre-funding in a one-day transaction. Huge benefit. You're seeing that go. Trade finance, I mentioned a moment ago. Eliminate counterparty risk by validating the underlying invoices. Corporate treasury, like not crypto treasury, but multinationals. 50% of all global trade is internalized to multinationals. And these treasurers don't have a view of their assets, their cash positions globally. They face cross-border frictions. That's another huge use case. So I think what we need to do first and foremost is be more selective about the areas we are going after and be looking at what benefits users of the product, not what benefits distributors. I think a lot of this is pushing a channel that doesn't always understand what they buy. I want this to be about financing the economy, not financial engineering the casino.
I think they do understand what they're buying. It's just not solving the real problem that there is out there, which you quite rightly mentioned, that you can actually go and buy those equities. Of course, a little bit of delay in terms of settlement and access and liquidity, and especially for Europeans as accessing American ETFs. But I fully agree that we should look on the real world assets that don't have the specific features that are required for the liquidity, for the settlement, for the cash management. What other products in addition to the ones that you mentioned? So we have private credit. We have tokenized collateral, trade finance. What other treasuries? What else?
The three I mentioned were, collateral mobility is a huge use case. I think your fund is great for that. I'm posting back and forth every 15 minutes and I'm earning interest in those 15-minute. That's a great use case. Private credit, I think, is a broad category. We also need to disentangle that. For me, trade finance or financing of receivables is one. More broadly, it's asset-backed finance. I think you need assets where it is possible to represent the life cycle events of the asset. So make a distinction between tokenization, which is basically just putting a share stock on a registry, and digitally native issuance, where you're representing the multiple life cycle events of an asset: origination, amortization, repayment, various events that can be automated on chain. Then you're getting that opportunity for cost reductions. Trade finance, like I said, is a great one. Asset-backed finance is a good one because you can validate things. Investment in SMEs as equity or debt, much harder to do because those are more bespoke. They don't lend themselves to the same standardized evaluation criteria. And then the treasury use case I mentioned.
Let me disagree a bit, if it's like a standard answer here. So I've been in the space for a while, and I remember 2016-17 era of let's implement blockchain everywhere. And you guys think is speaking right now, and it reminds me this early days was when I was a bit younger, and the idea was we'll implement blockchain in trade finance, we'll implement blockchain in transnational shipments, whatever. So I think there's not so much of a use case there. Right now we are facing like pretty straightforward approach, like we're tokenizing money market fund, we're tokenizing treasuries because there is some demand from crypto natives to use the kind of product which is not connected to crypto, which can bring decent yield. And the biggest question, will it bring this kind of yield like in a year or in 2 years? And we don't have enough stable coins in circulation to allow big institutional players to even pay for the services and do some international transactions with the amount of stablecoin NES that we have on the market. So all these potentially great ideas, I think they cannot work unless we're going to solve basic questions. And the previous panel was really great, like stablecoin adoption, basic primitives of financial markets like treasuries, like money market funds, like CLOs, and so on and so forth. Yeah, it's just a short remark. Thank you.
I've started this disagreement. Can I try and change now to saying that I actually agree now?
Now you agree.
Yeah? Now I agree. That,
okay, what do you agree with specifically?
Because it's not entertaining anymore to disagree. So
please don't agree just for the sake of it.
No, I think one of the best things that this community was doing for years, it's not institutionalizing things, but building new products, building new services, and that's what was exciting about it. But now, if you go to AI conferences, there's much more vibe, more money, more people. It's getting much more exciting. And unless these communities, that the crypto communities that we are part of, go back to the drawing board and start building new products, new services, and start creating value as opposed to becoming institutionalized with like what we are. I think it's these conferences going to be a little bit more duller and duller, and we'll look back thinking, say, oh, those were great days. You remember we're on stage and people were listening to what we had to say. But I think the true matter is that we need to actually add value by building new products, building new services, coming up with the new ideas. Selling just Bitcoin is not enough. I see, largest global exchanges now going to the banking 2.0, creating new banking operations. So like Bybit, we've got cards, we've got payments, we've got settlements, we've got investments, savings, cross-border opportunities under one platform. This is the future. This is what we should be doing in building new products, new platforms, new opportunities, not like going back to nostalgia or trying to institutionalize something that has been created 5 years ago.
Okay, so we said we have a bunch of products. We're building new products that should lend itself to creating demand on the institutional side. Then, Michael, you said that we're building the wrong things, we're tokenizing the wrong things. Roger, where do we land?
Yeah, it's a very interesting panel to interfacing with about how much disagreement we might have about this future space. And maybe I have a lot more optimism because we have built something new.
You are looking at
and
the
so we
practical
see
side.
that, and just like a lot of new technologies, permeating that technology takes time, effort, and persistence, and there's been roadblocks. But I'm reminding myself that these organizations, these entities like Binance and Coinbase and Kraken literally have hundreds and hundreds of millions of digital wallets. They also have securities related businesses in the background that they are ready to deploy to be new distribution channels for the legacy asset management industry. And as a result, you're going to see the asset management industry, as soon as they solve certain problems. One of those problems in the US, that's a real situation, is that the SEC has not yet allowed for third-party distribution of what we call digital asset securities. We call it Benji. It's a money fund. FOBXX is its ticker. It's a security. It rides on blockchain rails. Therefore, is it a digital asset security? Well, the asset management industry outside of the relies, yes, on distribution to make that happen. And as soon as they have the opportunity to find this massive new distribution channel, they're going to be running to it, and they're going to be looking at first at their current products and to say, what is the demand from these customers and clients? Is it for private credit? Is it for equities? We have plenty of great solutions in that case, but we're going to get these wrappers in this space because there's a lot of new customers to be able to essentially attract. So I think that we're going to see this trend come online. Now, like lots of things, and Franklin Templeton can be true, Franklin Templeton too, it's really easy to create products. Whether those products actually meet demand is another whole story. And I think the tokenization of the current path of tokenization of stocks, where we're tokenizing something else that holds a stock is an intermediary step, you have these impediments. They're called investment banks, and they've been in the business of helping do IPOs and make a bunch of money on the origination of those securities and the distribution of those securities. They're not going to go lightly into the night. They are an intermediary in doing that. But I'm pretty confident that, and I've been in the asset management business now for 40 years and seen a lot of different innovation from index funds to ETFs to now this space. What I see, and this isn't necessarily RWA related, but this idea that blockchain creates a whole bunch of other things like trade finance that become fungible for us at Franklin Templeton to put into a product that can be sold to customers and clients, rather than trade finance being in the private pockets of the banks themselves to make big, high risk adjusted returns. And so I see those trends about expanding the opportunity set of investment opportunities that might come to the entire community because we're integrating blockchain rails. And let's be clear, in the US, the crypto natives have the seat at the table right now, right? I think the math is something like there's almost $200 million poised by the crypto natives to the midterm elections. The total amount that the ICI, the Investment Company Institute, is the trade group for the mutual fund industry, and then SIFMA, they have less than $4 million pointed toward the midterm elections. Who's going to be that part? What I counsel people is these crypto natives in their small, interesting, and sexy, almost $3 trillion industry is attacking this $130 trillion industry because they're the voice at the table and they're setting the rules at the moment. And I think that's going to be, I wouldn't get in front of that. I would try to get behind it and see where the opportunities might be to just experiment. The only reason we got to Benji is because we just began to experiment 8 years ago. It took us 8 years to get to this place where we're now, over $1 billion in AUM. But that's the story of a lot of innovation. It takes adoption, it takes some early advocacy, and then we know money funds are a $7 trillion industry. So we know that the new utilities that we brought to that are things that everybody wants. The things that institutions who hold money funds want those feature sets because it improves their current product and strategy. So those would be just some general thoughts, I think, to be mindful of.
I think that if I could add just a small thing to that, because I couldn't agree more. And this is one of the most interesting elements of frictions that we're about to see this year and the coming year, is that we have incumbents, the central banks and supervisory authorities that have been basically supervising and controlling the finance industry for years, centrally. Whilst the blockchain is disrupting in a way in putting decentralization, and the incumbents are protecting. The only force is able to change that is the newly elected political establishment, finance ministers, political parties, governments, cabinet members, who will be challenging the incumbents. And we'll see that not only in the United States, but in many different places, including Europe and some other democracies, where we'll see that newly elected politicians will be challenging the current status and the current position of the central banks and the supervisory authorities. And as you say, it's better not to be in the way of the two, but there's going to be some real friction there. And this is something very interesting to watch, and especially in the United States.
Patrick, please.
Yes, I am the guy who agrees with everybody here.
Really?
So we make a little bit a new peace and love round here. No, I just want to tell a little story. Why I am in blockchain, in fact, as a traditional banker. And it was in 2015. I was at a management meeting. I was at that time director at PwC, and there were two guys talking about Bitcoin. Okay, this was absolutely something. It was nothing for us, Bitcoin.
Did you buy?
But
we don't tell.
I am here tonight. Okay. No, but what happened? I went back from this conference, and we discussed internally with the PwC partner, and we said, okay, Bitcoin, that will not fly today for us. But there is an underlying technology which is wonderful, which is fantastic. And we will analyze this technology and we will see what it can do for the asset management industry. So this is what you said about the services. We need to build services. So this technology is there, and the technology is there to stay. and we can build wonderful services with it, and later on, the products will follow. And then there was an interesting thing from Roger about the crypto natives or the digital natives and the others. We are the others. I'm not a digital native. And we are at a period now, there is an inflection point of a generational change. That's totally normal. So we have still in the boards of banks, in the boards of big four companies, we have the other generation, okay? They are close to retirement. And they will say, okay, let's wait and see. And then we have the new generation coming in, and they will change it. They will change the services, they will change the products, and then things, I think when we are here in 5 years, things will be completely different.
Absolutely.
I wrote a paper back, or I cannot say I wrote it, I co-authored the paper, because in 2017, about the new business model based on blockchain technology in the asset management industry. When I read the paper today, everything what we have today, what we see, was in this paper. And this is wonderful to see that when you have an idea as a visionary guy, that at one moment in time, you see it come through. And we will see a future with a real institutional demand of RWAs. But we need also to talk about regulation, Anne-Sophie.
I know, but we're running out of time because we absolutely went off script here. But thank you for going with it, actually. I think it makes for a much more engaging conversation. And I do think that you have quite, I mean, at the end we'll align, I think. So in terms of regulation, yes, of course, I think we've heard it as well. Metallicus was very vocal about that, you know, we're seeing a bit of a lack thereof, a lack of appropriate channels at least. And there's political camps that go back and forth and we'll eventually get there. But okay, there are roadblocks, right? So if you had to pinpoint it now, what's actually like the biggest roadblock for demand and institutional demand to emerge properly and to be fully unlocked in practice? Regulation can be the answer, but just...
As I said, go ahead.
Okay, just a few words about regulation. Because this is always a discussion point since we have MiCA, okay? So, but I think that we have a good regulation because MiCA is just one single element of the full regulation that we are using. So we haven't rebuilt the regulation. The regulation that we use for all our products is AML, IFMD, MiFID II, payment regulation, and so forth. So this is the basis. Then we put it on top the MiCA regulation to manage the technology layer, okay? So I like to use metaphors. So if we take I take a metaphor from the sailing world. So in the sailing world, you have wind and you have sails, okay? The wind, you cannot change the direction of the wind. So this is the regulation that we have, and we have to work with it. Probably Nicolas will not agree with me, but the regulation is okay, let's say, but we need some clarity on different points, what we can do, what we cannot do. This is not clear for the moment, okay? But to finish my metaphor with the sailing is that the technology, these are the sails. So the sails, we can change them, and we are at an inflection point where we change currently our technology, our architectures and technology infrastructure in the institutions.
And so I think there's no question about clarity of regulation is important. So I'm going to pick, and people cover that quite frequently. So I'm going to pick two others because I'm more of a product and technology person. I think privacy is a huge one, and I think scalability is a huge one. I think privacy is a little like climate change. We don't talk about it anymore, but it's still there. What you talked about, it's not the Bitcoin, it's the blockchain. That really was the first wave of innovation. Bankers took a look at this and said, well, we don't like this private permissionless thing, but shared ledgers, instant settlement, no counterparty risk, sounds like what we do, which is basically maintain ledgers. Let's go do that. And the first wave of innovation, therefore, and experimentation all happened on private permissionless chains. And that was great for the incredibly important attribute for regulated financial institutions, which is control. You need to ensure, job number one is don't go to jail. You got legal responsibilities to your regulators, fiduciary responsibilities to your clients. You've got to operate within regulatory perimeter. Private permission was great for that. What it wasn't very good was at job number two, or priority number two, which is connection. Markets are networks. You need to be connected to the broader pool for liquidity, for innovation and developers, for customer sets. And so now we're seeing a rush back onto permissionless chains, but I think it's still very much advanced POC, let's say. 10 trillion of treasuries on chain, US treasuries on chain, 10 billion on chain, 30 trillion outstanding. It's still a very, very small, not real penetration. I think we're gonna come back and we're gonna have privacy be probably the #1 issue. How do you obscure transactions so that people can't see who I'm trading with and how much? There are a variety of applications, or there's homomorphic encryption, there's T's, there's ZK proofs. At Avalanche, we've got a combination of our multi-chain architecture, which makes it easy to spin up interoperable.
Hey, bro, tell me why everything he's fucking talking about, Canton
can do that. Canton gang, bro.
Is this dude from Algorand?
Shit.
Yo, wow. Hold on. Let me see real quick. Who the fuck is this dude, bro? Oh, Falcon. No, maybe he's not from Algorand, but dang.
Oh, Falcon Finance. Oh, we went over that in the Well 28 Club last week, as a matter of fact. So,
man, interesting time to be alive, bro. I'm telling you, more and more people sleeping on that Canton, boy.
Yeah, bro.
Every time I hear people talk about, oh, privacy is something we need to solve, all I can think about is how many times you've always been like, shit, we already solved it. We solved it back in 2014.
It seems like Canton, Metallicus, that these guys are solving problems, and not too many people that are in the industry, high level like this, are even aware. So it's kind of crazy. But
I'm debating on this live right now to hold this XRP trade I'm in right now. I'm up like $6,000 in the market, getting after all this volatility in the morning, man. This rising freaking Trump's tariff vote. We got PCE inflation that came out. We got freaking the downgrade of the de-escalation of the Iranian tensions slightly.
the GDP as well that came out.
GDP. Yeah, bro. It's interesting. Interesting.
Yeah.
All right. Well, are you good to go? Are you done trading, or what's up, bro? You want to start?
I'm gonna trade after we're done, so I didn't want to be in a trade while we were on this call. So yeah, I'm good right now. I'm Gucci.
Did you trade this morning or no?
Yeah, I traded a couple times. I'm kind of down right now, but it's all good. The volatility threw me off today, so it's all good though.
Yeah. Today was definitely a curveball, bro. A dump right before the market opened, and then they turned everything around.
Yeah, and the entries were weird. Like there was not like good clear fib entries. Like it was like not respecting the fib today at all. So
you ought to take on days where MNQ is a little bit daunting for you, bro. You ought to take a look at XRP's price action, because day trading XRP, because of how slow the volume and volatility is, bro, it's so clean and easy to wait for setups.
yeah, I might have to pivot then.
You know, just to give you that fix, play around on Fulcrum for a little bit while when MNQ feels a little daunting for you.
Yeah, that's real. That's super real.
Give me a second. Let me pull up all my stuff real quick. Make sure I'm on the right path. All right, I think I got all my tabs ready. Alrighty, yeah. Today, guys and gals, I just want to go over some very interesting developments that are taking shape on not only the XRPL that recently came out today. We'll go over those fundamentals, take a look at some DeFi protocols that have fully materialized and come into fruition being built out on the XRPL. And then I want to allow that to roll over into some other interesting developments taking place recently on Coinbase, where Coinbase has allowed for lending up to $100,000 worth of your XRP, Litecoin, Bitcoin, so on and so forth. So we'll get into those developments as well. Take a look at something that's being built on, I believe, Stellar as well in terms of DeFi. related tools to get your digital assets working for you. That is coming soon, according to a post that we're going to dive into, and then just kind of show you guys how all these announcements in regards to, XRP and XLM DeFi, Metallicus has been sitting at the forefront of all of these developments, sitting there already able and willing to offer yield capabilities for XRP holders and XLM holders. So it's just interesting that all these announcements say for the first time, but Loan Protocol is one of the only, if not the only, BSA compliant DeFi protocols readily available to all users across the board. And they've been offering lending and borrowing on both XLM and XRP for over a year now, right? So
yeah, that's real.
We'll dive into that. And then last but not least, we'll roll into some Canton developments. I had a very interesting awakening yesterday on Aquaman's Zoom call in our private community on our Thursday calls. One of our members, Patoy, was talking about how you can split up rewards by creating multiple different wallets on the Braun wallet to generate more rewards if you don't have certain tier structures on the Braun wallets to meet higher threshold rewards. So I want to go over that a little bit as well, and then just go over some interesting developments in regards to the Canton ecosystem. So that's what we're going to dive into in today's call. Aqua Bro, I know that you don't know what I'm going to be sharing today, so just feel free to pause, open the discussion. I'm going to take a break after I share each thing. If you want to chime in, you're more than welcome, bro. All right?
All right. Yeah, sounds good, bro.
So this first post I want to share was from our, the OG in this space, like Sandy Call. I don't know who it was. I think it was actually Jenny Johnson sitting on stage with the Algorand CEO explaining who Sandy Call is. And I did not know how deep, like I knew how deep Sandy Call went. She's got credentials at the DTCC, World Economic Forum, CFTC, and currently works at Franklin Templeton. But in this particular CFC Maritz panel discussion that Jenny Johnson was on, I'm not going to play this clip, but she talks about where Sandy Call and how embedded into traditional finance she has been for well over, I think, 2 decades now. And she said something super crazy where she was like, back in the day, anybody in financial services that wanted anything approved had to go through Sandy Call. Like, she says something mind-blowing that just, I was like, dang. So when Sandy Call speaks, we should listen. That's not what I'm here to show you guys. I'm here to show you that Sandy Call reposted this over on her LinkedIn profile. This is Jenny Johnson at the CFC Maritz platform that took place, the summit that took place 2 or 3 weeks ago. And Jenny Johnson here from Franklin Templeton says, look, digital assets are going to be embedded into traditional finance. I'm bullish, right? So just take a second and listen to what she says here.
Oh, totally bullish. No. I mean, look at it is going to take over financial. Oh, totally bullish. No. I mean, look at it is going to take over financial. Blockchain is going to be the infrastructure of financial services. There's no question in my mind on that.
Okay, what a way to end, huh?
Oh, considering the current landscape, I feel like that is a very well-needed boost of morale,
Yeah. To just know that blockchain is here to stay. It's still developing. It's a bloody market right now, but yeah, it's not like blockchain is going to disappear. These guys have their eyes on it. They've been testing it. They like some of these projects. They're using some of these projects. So yeah.
Canton and Stellar both being projects, layer ones that Franklin Templeton has partnered with,
Yeah, that's real.
So just keep that in mind, guys and gals. These are the types of video breakdowns, the little tiny clips that the mainstream won't show you. They'll just promote fear, uncertainty, and doubt. Rolling over here, this is going to be the highlight of today's call. I really wanted to share this breaking announcement with you guys. This is from Soil Farm, and they have officially launched its real-world asset-backed yield protocol on the XRPL. Round of freaking applause. Finally, we're starting to see some good regulated DeFi developments take shape on the XRPL, guys and gals, that retail users can use, right? This is huge. It says bringing compliant yield generating utility directly to Ripple's RLUSD stablecoin. This isn't theory anymore. This is real infrastructure, real capital, and real demand, with the first $1 million in vaults filled in under 72 hours. So there's clear demand for this. This confirms three things. The XRPL's native lending functionality is now live and being used actively. RLUSD is gaining immediate utility beyond simple transfers, which is great. And then soon capital will actively, of course, start flowing into yield opportunities onto the XRPL. And then down here, Tony, shout out to Tony. I'm pretty sure he's in our community. He said 5 to 7% fixed APR for treasuries plus private credit on the XRPL native lending. No bridges, no nonsense, just compliant real yield for RLUSD holders. This plus XRPL already surpassing Solana and real world asset TVL is a massive signal. Well done, Soil Farms. I personally diversify into RLUSD just as, you know, in some of my stablecoin positions. So this is phenomenal. I'll definitely be checking out this platform relatively soon, right? I'm going to go over it in today's call with you guys, just taking a look. Me and Aqua have been talking, man. Aqua, when did we start talking about DeFi developments on the XRPL?
2 years ago now, bro.
2024, right?
Yeah, it's been 2 years. 2 years, definitely.
Matter of fact, there's XRPL Las Vegas coming up, and I think when we first discovered it and started talking about it was when we noticed David Schwartz telling the XRP Las Vegas audience that you can start to put your idle XRP to work in liquidity pools on the XRPL, and nobody said anything at XRP Las Vegas. It just kind of like went over everybody's head.
Because he had said it in such a disguised way. I think he had said like he used the word arbitrage, so it just went right over everyone's head and shit. So yeah, we were paying attention though.
Very close, 110%. Here's the official announcement from XRPL Commons. They put this out 28 minutes ago, so this is relatively fresh. You guys are seeing it hopefully for the first time today. Now, I already read the announcement. I just posted that on my Twitter profile. I want to actually play this little tiny clip of, I forget this lady's name, Odelia Tortman, head of or director of corporate adoption at the XRPL Commons, and she's sitting on this little tiny, I don't know what this is, venue, talking to the gentleman that built Soil Farms. I haven't listened to this yet, so let's just take a second and listen. It's like a 3-minute long video clip, and just let's see if we have anything interesting to digest here.
Yeah, sounds good.
All right, good evening, everyone. We're here in London at the XRPL meetup, and we're extremely excited to be here with the amazing Soil team that have very, very recently launched the first DeFi product on the XRPL using Soil platform. So Nick, why don't you tell us all about it?
Hold on a second. Did she say the very first DeFi product on the XRPL?
Yeah, I was like, damn, that might be cap, bro, but I'll continue to listen.
That's crazy if it is, because just think about how early we are then in terms of DeFi developments on the XRPL. That's massive, right?
Yeah, it is.
This is just happening today, you know?
The Dune vaults. So
all right, good evening, everyone. We're here in London at the XRPL meetup, and we're extremely excited to be here with the amazing Soil team that have very, very recently launched the first DeFi product on the XRPL using Soil platform. So Nick, why don't you tell us all about it?
yeah, hi guys. Nicholas Motz here. I'm the CIO of Soil, one of the co-founders. So it's been over a week. We launched on XRPL, our RLUSD yield. We filled up our first vaults to $1 million, which is super exciting. We see the demand. We're getting emails when the next one is opening. Sneak peek just now is opening the Dune vaults. So super excited to what comes over. And yeah, over to you, Jacob.
Yeah, tell us what else is on the roadmap.
So the main product on the roadmap is an opportunity for users of XRP token to get lock these tokens in our protocol and earn a passive income based on the allocation. So I guess this will be pretty exciting and completely new product for customers on the native XRPL.
Amazing. And does this also include the RLUSD?
So the product will be mixed. Of course, more details to come, but we are thinking about 2 options. So first of all, if you lock XRP on our protocol, you will have an opportunity to get a native token as a reward, or RLUSD as a reward. So you can have a choice to decide what kind of reward do you prefer.
Fantastic.
If you want to build up your stake of XRP, or you want to get a reward in RLUSD. So a
Very
lot of options
exciting.
for the customers.
Very exciting. And tell us, how are you using the XRP ledger and some of the features, with the upcoming amendments that we have?
Yeah, so amendments is exciting. So thank you. First of all, thank you for your support, Odelia, and for common support. Thank you also for the big support of the community of XRPL, because they helped us, especially Krippenreiter, who take over the tests of the protocol, and he did a very deep dive into the protocol compliance, etc. So he was a huge support for us, and whole community was very supportive. And about an amendment, we are more than excited, because amendment is opening the gates for institutional money. So we are about in 70% developing the product. So happy to introduce you soon.
Very, very exciting. And what else do we have on the roadmap in terms of new vaults, new products?
So as Nick said, last week we had a very successful launch. We filled out all the pools, and today we reopened the pools for the other customers. So today all the pools will be available again. You can allocate your stable coins or USD and earn the passive income on your stable coins. So
fantastic. Very exciting time, guys.
Not too shabby. I'd say that this is just huge confirmation on this protocol itself, that they're sitting there with the representative directly from Ripple, right? Not only that, I think the best takeaway from this is that you have the ability to earn your rewards in both XRP and RLUSD.
Yeah, I think that is definitely cool. Is the project up? Like, we can access the platform now?
Yeah,
or?
no, 100%, bro. I'm gonna go over it right now. Absolutely.
Okay, dope.
I'm already thinking about strategies. Like, think about how cool that would be, right? So when the market is down, okay, when the market's discounted, like it is today, to this day, right? I mean, comparative to where certain people probably bought some of their XRP years ago, it's not discounted. But in terms of like market cap and in terms of where the market was back in October compared to where it's at today, the market's discounted. This would be a time where you turn your rewards into XRP, right? While the market's discounted. So that way those rewards, once the market flips back bullish, appreciate in value. And then you're kind of like doubling your bag almost, in a sense.
Yeah, your rewards are dollar cost averaging for you. You know what I mean? So,
and vice versa, when the market's at a premium, when prices are pumping, the market's bullish, everything's raging, you flip your reward sentiment back into RLUSD to mitigate that downside risk on a pullback.
Yeah, facts, bro. I actually want to see this platform. I can't wait till you pull it up. I'm actually kind of intrigued now.
So this is their LinkedIn profile, right? Overview, it says, Soil is a fully regulated DeFi protocol that provides secure returns on stablecoins backed by real-world assets. Soil is a blockchain-based lending protocol that bridges the gap between traditional finance and the crypto world, reshaping corporate debt and fixed income investments. It is a debt marketplace where established companies can obtain financing and crypto investors can lend their stablecoins to earn yield derived from real-world assets that exist off-chain. So I'll definitely be going and trying and attempting to deploy on this platform relatively soon with some test amounts for a couple of months. But coming over here, one thing I will say before we dive in is that you do have to KYC on this platform. So I went ahead and I tried to verify my identity before this call. I wasn't able to do it in a quick, timely manner. I mean, I'm sure it's probably a speedy process, but I didn't want to do it while I was on the call. But I just wanted to show you guys that you do have to KYC because they are regulated protocol, which is probably going to become the new normal for protocols across the board, right?
I would say this is probably the first of its kind then on the XRPL. It makes sense why they're stamping it and calling it the first DeFi protocol, because you have to go through KYC. I feel like everything else that's on the XRPL right now, as far as like magnetic, whatever else I can't think off the top of my head right now, you don't have to KYC to get onto those protocols. So this is a major step in the right direction of what we are aligned on. So I'm actually excited about this project, bro. Real talk.
110%. So just taking a look at the protocol itself, here it is. You guys have launch app. By the way, I connected with the Bifrost wallet. I don't know if you guys, they have the wallet connect feature, right? So you can connect with different wallet connects, compatible wallets. What I do like here is that it does look like it runs on multiple different chains, which I think is cool. So if you actually come over to the protocol itself, I know it sits on top of the XRPL, but where is it at? Scrolling up to the top of this. Hold on, give me 1 second. Where was it at? Oh, sugars. Oh, here it is. Okay. Share this tab instead. All right. So you come up here and you're up on the top. So this is what when you click launch app, this is what the user interface looks like without KYCing. Of course, to get actually into your dashboard, you do have to KYC, but you can still click on the earn tab, the liquid stake, and the fixed yield pools tab, which is what that gentleman was just talking about, how the fixed yield pools filled up with over $1 million in 72 hours. And now they're going to launch more fixed yield pools, which is cool. But it says here, select network, and you can see the networks that it offers: Polygon all the way through Plume, Avalanche, OP Mainnet, BNB, Base, Arbitrum, Ethereum, which I just think is cool, right? Backed by real-world assets, secure and transparent, USDC-based yield, continuous AI-driven portfolio rebalancing. What? See that right there, bro?
Yeah, no, that's dope. I'm trying to bring up, what's the is the URL xrpl.soil.co? Is that the correct one? I just want to make sure. With so many different.
It's app.soil.co. I'd go straight directly to their Twitter profile to get the proper link. So just type in soil_farm and then you'll be able to pull it up. I want to go back to their homepage. What I really like about this, and this is something that us in the CyberX community really pay attention to. Not only are they regulated, they're KYC, right? But you know who the freaking people are behind the protocol. So if you come directly down here, boom, transparency. They introduce themselves. They're not hiding, right? I love
some
seeing
weird AI created fucking characters, real people, real voices.
Yeah. So let's listen to what these dudes have to say, you know, giving them a platform, because this is obviously, of course, their day launch. Well, they launched 72 hours ago, but nonetheless, it's live, it's available, it's ready to use. So let's just listen to this little infographic that they have on their website.
Hi, I'm Mike, CMO. Welcome to Soil, where decentralized finance gets a powerful upgrade. We are here to show you what's new, what's next, and why Soil is set to transform how you interact with DeFi.
Hi, I'm Nick, the CIO. From blockchain expansion to liquid stake, Soil introduces new features that offer greater value, more flexibility, and longer-term growth for our users.
Let's dive into the key innovation that we have built into the new version of the protocol. The new version of the protocol is all about the growth. We have expanded to the new blockchain. After launching on the Polygon, Soil soon will be also available on the Ethereum and other EVM-compatible chains.
And we're not stopping there. We're exploring grant programs to deploy Soil on emerging blockchains with huge development potential. This is just
$5 says they deploy on Canton.
The beginning. To meet the needs of investors who value flexibility and instant access to their funds, we are introducing evergreen short-term pools. No more locking up your capital for long-term periods.
That means that investors can now generate attractive yields on the stablecoins without sacrificing liquidity. It's a DeFi on your terms.
With the new version of the protocol, we've enhanced your tokenomics. From now on, all pool rewards will be paid exclusively in stablecoins.
By eliminating rewards paid in Soil tokens, we are cutting inflation and making Soil even more scarce.
But holding Soil tokens still gives you more, higher yields, and stake in the long-term growth of the protocol.
To show our commitment, we've relogged 100% of company-controlled tokens for an additional 2 years. That's over 50% of the total token supply.
This, along with the ongoing token burn activities, we've reduced supply over 6% in the past 10 months.
It makes soil tokens even more scarce.
And we are just getting started. Soil's roadmap includes DCX, our decentralized credit exchange for trading liquidity position and bonds.
Plus, we're introducing MMI, an open API that offers external partners to integrate Soil's products. This will drive growth, expand our product offering.
Hey, yo, am I getting bullish on Soil right now?
I definitely am, bro. That's open source, bro. What? That's sick.
We definitely might need to look into this Soil token here for a second. And they mentioned staking rewards, right, on Soil. I like that they also said that there aren't high extended lockup periods, so you don't have to like contribute to some overextended lockup.
Yeah. And they got liquid staking too, so we can double dip, it seems like.
Oh, bro, there's definitely, we're going to be running strat on this protocol in the Wealth 28 Club for sure.
Yeah, without a doubt.
All right, so that was their little infographic on their website. I'm not going to read through this entire thing. Definitely something that I feel like people should check out. Obviously, of course, not financial advice. Use your own discernment and your own risk-assessed adjustment. But trusted by Ripple, right there at the forefront. DIFC, Securitize, some big names here. We can see Chainlink, Market Across, Seedify, WH Partners, Hackin. Team members, like I said, all LinkedIn profiles. Here's the team members, how it works. Then if you come up here to their FAQ up at the top at the about page, contact FAQ, you guys can read a little bit about the protocol. Definitely go do your due diligence, check it out. We're going to be bringing this to our community's attention in the Wealth 28 Club. I thought that I'd bring it to your guys' attention on our Friday podcast for the first time. But yeah, this platform looks super awesome, especially if you have idle capital sitting on the sidelines and you're bullish on digital assets like XRP. You heard the gentleman mention that you can earn your rewards in XRP. So if you're bullish on XRP and you don't have money to dollar cost average in, but you have some idle capital sitting there, you can go and you can put it to work and you can get paid out in XRP. So every single day, you're dollar cost averaging in XRP without having to do absolutely anything, right?
Now, are we going to see where you're clicking at right there, the different networks? Are we going to see the XRPL as an option then eventually? Is because I don't see it up there as an option.
I'm not too entirely sure, bro. I don't know. I don't see it either, but we'll see.
Okay.
We'll see.
Yeah.
Maybe, you know, it says that they just launched on the XRPL, so I don't know. Maybe it's coming. Maybe they need to update it. You know, this list.
Yeah.
I don't know. We'll see. Current APR 3%. I'm definitely going to look into this a little bit better. They got a swapping feature here, vesting. Let's see. No, I don't have any tokens locked, so it doesn't give me any data. But this looks super cool. Again, like I said, guys and gals, go check it out. If you come over to, let's see if I go back to their X profile real quick so you guys can see. Plans in real world for XRPL's growth. Soil_farm is their X handle. So, you know, go check them out when you guys have time. Do your due diligence. Stop holding.
Wait a second. I think that's it right. I think that's it right there. You see it right there? xrpl.soil.co. Click that. I think that's the site I was on, and it shows you RLUSD. Yeah, that's where I was at.
Okay. Yeah. So there's a separate site for the XRPL.
So it's already here. This is where I was at. And I was like, wait, am I on a scam? So it's good to know that this was the real site then too. So
turn your idle RLUSD into real yield and unlock seed rewards. Yeah, bro, this is going to be a joke. I'm liking these percentages too. Healthy 5 to 7% yields. Early access has its perks. Soil is building. Yeah, this is great. This is awesome.
And if we can double dip too, because it looks like there's an option for liquid staking on their main site, and let's just say they're giving out 7% on that, then we could double dip and then bring it here and get another 7%. So we could rack up like 14% in yield. So
no,
definitely.
We're gonna be running strategies on this platform for sure in the coming weeks ahead.
Yeah, this is dope though. I like how clean it is. This is honestly, this is one of this is the only clean, like the cleanest DeFi I've ever seen on the XRPL. So
hands down, it's the cleanest for sure. And according to the announcement, the only regulated one as well.
Yeah, bro. This is an awesome step in the right direction for the XRPL. If we can get more of this developing and created, there's definitely brighter days for XRP, like 1000%.
110%, because all that needs to happen, bro, is the idle liquidity that's sitting in centralized exchanges or in just HODL wallets just needs to get unlocked, bro. I've said this so many times. The reason why I'll never sell my XRP, one of the primary reasons, setting aside its cross-border use case and its payments use case and all these blah 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 bullish moon boy replacing Swift crap, is simply just because it's in the number top 5 of market cap, and if just $30 billion of that money shifted over into DeFi and became active in the DeFi ecosystem on the XRPL, the demand P would freaking skyrocket, bro.
Yeah, bro. I ain't gonna lie. I was losing confidence the past 6 months on the XRPL. I think I've kind of expressed myself on our Friday call a couple times, but seeing this today, I'm totally 180ing my mindset now on the XRPL, because this is what they've been missing. This is what needed to happen, and it seems like there's probably going to be more of this to come. Hopefully this year as well. Shit.
I think in regards to DeFi, anybody that was losing confidence in the XRPL in terms of their DeFi capabilities is, has the right to, because I mean, look at how many months and years have gone by where companies and different networks have promised certain things like, give me 1 second.
Yeah, no problem, bro. Yeah, they got a liquid.
Sorry about that. I was
No
saying,
problem, bro.
I was saying that I feel like, all the plans and promises that have been established for XRP holders to generate yield on different protocols, different networks, it's always been sketchy. It's always been like iffy. It's always been, we're going to launch on this date. The date comes and then they push it back freaking months. So this is great to see. I agree with you 100%. This is a step in the right direction. And if we can see more of this consistently over the next 6 to 8 months, super bullish for XRP.
Yeah, 1000%. This is going to bring so much liquidity to chain, 1000%. And they're aligned with compliance. Yeah, bro.
In regards to XRP announcements, this isn't just XRP related. It has everything to do with just the, major centralized exchanges going into like this whole notion of DeFi capabilities, right? Coinbase announced just yesterday, February 18th, 2026, holding XRP, Doge, ADA, or Litecoin. Now you can unlock the value of your portfolio without giving up your position, borrowing up to $100,000 in USDC against your tokens instantly without selling. Available now in the US, excluding New York, of course. What I find interesting about Coinbase is it says now you can unlock the value of your portfolio. But like I mentioned, in the Metallicus ecosystem on the loan protocol, which is a BSA compliant DeFi protocol, the only one, if I'm not mistaken, has been given these capabilities to all of these types of holders, Doge, ADA, Litecoin, and XRP for years now.
For years now, 1000%.
So to anybody that's been operating in the Metallicus ecosystem, this is nothing new. But for those of you all who do use Coinbase, who trust Coinbase, this is still something cool. I don't really know I've ever spoken to anybody that trusts Coinbase. Like everybody's always like, yo, I use Coinbase to buy crypto and then I'm out, But that's still cool to see. That's still cool to see. And what I liked about this post is down here at the bottom, Templar Protocol posted this and said, borrow against your XRP, Doge, ADA, Litecoin without trusting centralized intermediaries or incurring a taxable event, coming soon to Templar. Because Royal Fool down here on X mentioned that if you do utilize this feature on Coinbase, it says this incurs a taxable event. When you wrap your XRP, when you wrap your XRP, Doge, ADA, or Litecoin to the ERC20, used as collateral on Morpho, which is what Coinbase uses, it triggers a taxable event. So it's good that you have other protocols that are going to offer this capability without triggering a taxable event. That's good to know. But coming over here, I never really dug too deep into the Templar protocol. And it says here that Templar is launching on Stellar. So this is from November 5th, 2025, last year. I'm pretty sure we covered this in minute detail. We didn't go too deep into it, but it says Templar, the first cipher lending protocol, is launching on Stellar. And according to their more recent posts here, they are obviously, of course, going to be allowing for borrowing against XRP, Doge, and other digital assets without having to trust a centralized intermediary. So I thought that that was cool as well. But like I mentioned, you know, this post from Coinbase here, where they say now you can unlock the value of your protocol. You come over here to the loan protocol. They are the only one in DeFi that is BSA compliant. They said here on February 11th, let that sink in. And if you come over here to the loan protocol, right, you have all of the MetalX update, by the way, I think is super clean, super efficient, where you can see all of your rewards in one place. You can see your XPR stake in one place, your loan stake in one place, collect your fees and farm pools, the loan protocol, and on any of your lent out positions, all in one user interface, while having the trading platform all integrated into one UI interface. So I think that that's pretty cool.
Yeah, super clean. What is the lending and borrowing looking like right now as far as yield on stablecoin positions? Is it still?
Give me one sec. Let me pull up the loan. Right now, 2.91%. Nothing too extravagant, but still steady for anybody that has idle liquidity. There's clear demand for it with $4 million, lent out assets. Their XRP is still slightly too small for me to want to take the risk. 22%. I do have a crap ton though of my H bar, pretty much almost over half of my H bar position on MetalX, earning 1.45%. It's been making me about $3 to $4 per day, which is pretty cool because I just loop it back in every single day at 10:30 p.m. at night, and it just grows and compounds and compounds and compounds. Metal Dollar is looking a little bit better at 3.3, and Tether is slightly down as well.
Some of these assets, though, not financial advice, but it kind of makes sense to run a strategy, especially a cash flow strategy, to borrow against them. Like HBAR is paying out 4.3, Stellar 4.75. If you were to keep your LTV relatively really, really low, borrow against it, you would earn that, but then you can take what you borrowed and go and play with it in some sort of, some other DeFi protocol. And I feel like there's more to come on that. So like once regulations and compliance is really here, running a game like that would be, everything is BSA compliant, everything is compliant, would make sense, so we'll see if these will stay like this in the future once compliance is here. And there's more compliant protocols to start, placing your money here and getting it working for you. But yeah, in some cases, it might make sense to borrow against it, but not financial advice, of course.
I mean, think about it like this, bro. You got two compliant platforms here that we've shown you today. Obviously, of course, I'm not telling you guys to go run this strategy. Just consider thinking about it in the future if regulations overall is what you're waiting for. But, like Aqua said, you can come over here, lend out your HBAR. You don't borrow, obviously, of course, the max amount against it to minimize that liquidation threshold. So you lend it out, maybe you can borrow up to 75% of it. On loan protocol, you borrow 60% of it to give yourself that 15% cushion. And then you take that loan and you go and you put it out, in something else like the Soil platform, where you can earn 7% on that. So you're earning 1.45% for lending out, 4.3% for borrowing, and then paying back your loans steadily with the 7 to 9% that you're earning over on your stable coins on Soil, right? And you're taking that yield, and you're putting it back into your loan to pay off your HBAR. There's so many different great strategies that people could run if they understand DeFi properly, which is, again, why we encourage you guys to tap into the Well 28 Club and learn how to get your digital assets working for you.
Yeah, 1,000%. 1,000%.
This was pretty cool to kind of start to slowly wrap this up, go into more of the Metallicus ecosystem, since we were just talking about the loan protocol, and then roll into the Canton reward strat that I want to just talk about that one of our community members highlighted. But 21 hours ago, I don't know who this lady is over on LinkedIn. Oh, excuse me. Actually, matter of fact, she's Karen McHenry, the VP of product at Metallicus. She posted this, and it says, as you prepare to head to GAC, there are a couple of events happening next week that would be great to get you up to speed on. Some of the topics we'll shortly be discussing in DC. First, we have the MDDC Credit Union Association is hosting a webinar in partnership with Metallicus about the latest stablecoin adoption. And then they have this registration link. So here you can see the upcoming events. It mentions CU backed and consortium and stablecoins, February 24th. So this is going to be in 4 days next week. And you can see, obviously, of course, Metallicus sitting at the forefront of this stablecoin credit union adoption. And if you guys come over here to the registration link, you guys can register for this. If you're interested, I personally register for it. I'm part of the TDBN community. I'm super bullish on the Metallicus ecosystem. So I'll definitely be there supporting and showing face and just learning, soaking up some information, as this is a educational session designed to help credit union leaders understand. It says using clear visual examples and walkthroughs of how credit union-backed consortium-backed stablecoins function in practice. And Metallicus is going to be sitting there at the forefront of explaining all this.
Yeah, I'm gonna have to sign up for this as well.
Link is in our Discord, bro. It's also over on my Twitter if you guys need it.
Yeah.
And then what I like about this is they have this post over on their LinkedIn of a post from John Ungerlin. All right. And we've played clips of John Ungerlin so many different times, but this is recent. This is from just 2 days ago. John Ungerlin posted this over on finnepotamus.com. And it goes on to mention just all this stuff, stablecoin developments on the credit union front. But what I really liked about this is these highlights down here, right? And paying attention to key vocabulary in podcasts that myself and Aqua have shown you guys before, I want to bounce some clips from what John Ungerlin said 2 days ago compared to what he said 2 or 3 months ago in regards to their partnership with Metallicus and how Metallicus is going to be the gate. They're going to be at the forefront of giving credit unions access in this new digital era to stablecoins. Hold on, let me find my other notebook. Make sure I have the correct notes for this. But here, John Ungerlin said 2 days ago, at the upcoming America's Credit Union Governmental Affairs Conference, the GAC in Washington, D.C. in March, which we know Metallicus is going to be at, I'll outline this imperative. Stablecoins serve as the doorway to the broader world of digital assets, a threshold, not a destination. Credit unions must not linger there. They need to step inside and operationalize DLT holistically. Prioritize Bitcoin-backed loans, collateralizing with deflationary assets to hedge against fiat erosion. So he literally is calling fiat currency trash in this message, just in a very smart, intellectually inclined way. Integrate USDC, USDT with Bitcoin Lightning for sub-penny instant payments, and adopt non-dollar balance sheet strategies to diversify reserves and mitigate currency collapse risk. That's huge, right? Non-dollar balance sheet strategies. That's crypto, that's other things, right? Through credit union service organizations like the Land, tools such as coin-to-coin enable secure, compliant bridging of traditional finance, TradFi, and decentralized finance, ensuring resilience without overhauling cores. The strategic implications are clear. Embrace this guidance to catalyze cooperative capitalism, steward membership health toward sovereignty, and thrive amid data wars and economic shifts, and hesitate, and any credit unions forfeit their privileged role. This sandbox is open and now built for anyone. In short, keep working on staying plugged into the future of money, which will stretch beyond stablecoins alone. The Land Credit Union Service Organization is already building beyond the PPSI threshold. Our digital asset gateway, this is important right here, is anchored by the coin-to-core bridge and is structured to keep credit unions securely connected to and actively serving all forms of digital money and membership wealth. And so just thinking about that paragraph right there, when I play these video clips for you guys. Okay, that's something that he shared 2 days ago, talking about this event as well that Metallicus is going to be sitting at, discussing with credit unions about stablecoin adoption. And if we come back over here, this is from last year, 2025, towards the end of the year, where John Ungerlin sat on a panel discussion with Marshall Hayner. And I just want to play 3 video clips, one of which John Ungerlin mentions, we believe Metallicus will be the doorway to give our clients stablecoins. Okay, so like verbatim, he says that, not coming from me, coming from John Ungerlin, who just told you guys and 2 days ago that this is all taking shape at an event Metallicus is going to be sitting at the forefront. And then he also mentions trillions of dollars will flood into the industry and they will use metal, right? And then the last video clip that I want to play is where he goes on to talk about how these credit unions need to get plugged in, and that Metallicus and their partnership with Metallicus is going to be what onboards these financial institutions. So just bend your ear, like Aqua says here, and listen to what this gentleman here says.
It was really significant to find a partner that controlled their own destiny and had control of all the ingredients for offering a stable coin to the credit union and banking market space. And we loved what Metallicus was doing on the stablecoin front and other with their blockchain and DEX capabilities. And we felt like they would be a great partner for us to help provide a doorway of stablecoins and other services to usher our clients into the broader world of digital assets. So our solution that we refer to as coin to core provides a gateway to the world of asset whole and really makes digital asset data processing part of the native operations of a financial institution, so that they don't have to build expertise and train their resources in how to do the digital asset stuff, you know, for lack of a better way of explaining it there, or for time's sake rather. But want to give a simple way to integrate these new money types into what financial institutions are already doing for their communities, and do things like stop deposit bleed, help them retain membership, help them put digital assets to work in their community. And we know stable coins like the ones supported by Metallicus are going to be an important part of that doorway that folks will walk through in that world of digital assets.
So I want to cut to the chase.
Now, Aqua, bro, I know that we can't disclose this because of some information that the TDBN community has asked us not to disclose, but I've never said this to you before, and I want to hear your take. John Ungerlin just said, through some of the stable coins that Metallicus offers, and what do we know about what sits right now on the Metallicus ecosystem behind the scenes that nobody knows about, right?
Yeah.
All those stable coins, bro.
Trust lines, 22 trust lines that if you know what you're doing and you can go and search the Block Explorer, there are 22 live trust lines from 22 different individual credit unions that are in the banking innovation program. So yeah, no volume on them just yet, but I just think of it just logically, like, why would they activate them one by one? I feel like they're going to get them all ready and then activate them so then they can all communicate within that ecosystem. So yeah, I don't know, more to come on that, but yeah, without going any further on it, there's definitely 22 trust lines there.
I just put 2 and 2 together, right? He said specifically, and I quote, "We believe Metallicus will be the doorway to give our clients stable coins," and then also mentioned they're going to use stable coins that Metallicus offers. It's just, you know, it's anybody that does the research, it's right there. It's right there. It's transparent. Here's the second video clip where he talks about trillions of dollars will flood in and they will use metal. Just take a second and listen.
Crypto companies were denied bank accounts, and you see this with the latest ruling under the current presidential administration that crypto companies and individuals holding digital assets were treated unfairly. You may have seen this news. Now we can finally be treated fairly, and I think we should put our money into the local credit unions, and we should bring them back into our communities. And so that is just, it's the perfect, finally there is this opportunity to have banking services fairly and let's put it into our communities. So I just wanted to add that. I think that that's really important. There's trillions of dollars that are going to come in, and they need a place to go, and they're going to leverage this technology with Metallicus and DeLand. And so what's next in my mind is really
there's trillions of dollars that are going to flood in, and they're going to leverage the technology that Metallicus and DeLand has built. And here we have the gentleman from DeLand 2 days ago, right, talking about all this stuff taking shape, how they're going to be at this event in March where Metallicus is going to be sitting at, and what they're offering to credit unions. Like, it's all the fine tuning's all here, right?
Yeah.
Last clip I'll play for you guys is this one here, where he goes on to talk about how these institutions need to stay plugged in. And he mentions again, John Ungerlin, how the partnership with Metallicus is what's going to be the gateway to onboard these financial institutions, which just backs what Marshall Hayner just said. It's not cap. This is directly coming from John Ungerlin himself, who is the DeLand CUSO CEO. So, you know, don't take, I'm not just like making this up, take it from him.
Now, I'm sure that here's what will happen. If credit unions don't get plugged into that future of money and incorporate this type of money into their operations, then I'm sure JP Morgan and others, and, you know, Wells Fargo, Chase, Bank of America, they'll be glad to gobble up market share and service digital for the 21st century, service wealth for the 21st century. So as regulation and legislation develop and become clearer federally and at the state level and global level, it's really important for local FIs to be proactive about getting plugged into this gateway and into these new types of money, so that protecting their place in the stream of money. Here's what I mean by that. The next thing that we'll see coming is the digital asset space is going to erode your interchange income.
That's what I've heard.
If you're a local financial institution out there and you make money off of plastic cards, hypothetically, that interchange income is a significant portion of your non-interest income or your operating income. If it's how you're staying alive, I can almost guarantee you that by January of 2026, you will see major moves and announcements and plays by merchant processors and other large firms out there where they will adopt digital asset payments, they will adopt stablecoin payments, they will adopt Bitcoin payments, because it will have a significant impact on their operating costs, and they will incentivize consumers to move away from traditional payment mechanisms that are slower, more expensive, and less secure. So come downstream, more legislation, more regulation, driving the consumers into these spaces vis-a-vis FIs, and probably some disruption and challenges to payments. The good news is, through our bridge and gateway and partnership with Metallicus, we can make sure that your deposit dollars don't have to leave your FI.
Yeah.
You stay a funding source in the payment stream and the transaction stream, and you can maintain wealth and share of wallet and continue to serve the community even as money morphs in the way that other services did when they bumped into the internet in the past.
Yeah.
So that's what we see coming, and we're committed to ensuring the industry has a solid set of tools, the best set of tools, and a ready gateway, a functioning gateway. And I think another thing is, this is real. We've built this, it's functioning, it's live, it works.
Cool.
Another thing you're going to see coming is a lot of people announcing plans and promises, which is where we're excited to already have product and solutions that are turnkey for shops trying to solve these problems right now.
Go ahead, bro.
Plans and promises. Here we are, 2026.
Yeah, and it's happening. Everything that he talked about and mentioning, if you guys are tapped into this space, it's happening. It's happened already in real time. And I don't think that his vocabulary is by accident, because here he is again, right? This is the crazy part. He said specifically in that interview, right, months ago, he said, our gateway and our partnership with Metallicus is what is going to allow these financial institutions to onboard into this space, right? These credit unions more particularly. And here he is again 2 days ago saying our gateway, our digital asset gateway, right, is what's going to enable all of this. And he's talking about being at this event March, the very beginning of March, with Metallicus sitting at the forefront. So definitely something to be mindful of and pay attention to. Again, not financial advice. Coming over here, last but not least, okay, Canton developments. Canton, or excuse me, let me correct myself, Digital Asset posted this Consensus Hong Kong panel discussion that took place where Beatrice Callahan, Director of Sales at Digital Asset, went on to say a couple of bullish things on the Canton network, which I think I'm overall going to play for you guys today. I wasn't going to play them, but might as well. Just 2 quick video clips. And then that's going to take us into some other panel discussions from other systemically important people that mentioned that they are, for a fact, building on Canton. And then I just want to go over the reward strategy that one of our private members brought to our attention that just go to show that you can enhance and increase your rewards on the Bron wallet by taking part in this just little tiny tweak that I thought was actually really interesting and something to be mindful of and pay attention to. So real quick, let's just listen to this lady here. This is Beatrice Callahan, Director of Sales at APEC Digital Assets. And here she goes on to talk about how they are past the proof of concept phase. They're past the proof of concept phase during the live production phase. Take a second here and listen.
The world. No, so let me help. Something that we want to be private without creating a lot of like negative side effects.
Yeah, I just want to add to that as well. I think it's important as well for regulators and for jurisdictions that are a little bit more kind of bearish on what it is that they want to look at within the ecosystem. It's having in production use cases. It's having things actually work on chain that are generating value as proof points. These aren't the days of POCs or sandboxes anymore. We're past that. I don't know if anyone saw the press release. DTCC has just signed onto the Canton network to do all of their US tokenized treasuries and be able to extend it out to much more global markets. The liquidity already that we're seeing in demand from actually Asian brokers, like here in the region, having so many people coming on board saying, this is something that we want to be a part of. And actually those are in jurisdictions where regulation is not as far ahead as it is in other places. And it's as a result of that needs to happen. We need to be having like in production safe private use cases that highlight that this kind of scalability and this value add can be generated without it being this like huge turnaround in regulatory kind of. We need to reduce that fear essentially by proving out that this works and there's value in it.
So I thought that was pretty cool. And then another thing that she said in regards to a recent post from HSBC where they talk about their HSBC Orion platform being chosen by the UK, or I don't remember what jurisdiction it was off the top of my head, but she talks about how they're the ones that run HSBC Orion. So that's just verbal confirmation from somebody that works at Digital Asset that Canton Network is the underlying de facto beneficiator of HSBC Orion platform. Take a second and listen.
Hong Kong Stock Exchange. So we digitized the northbound stock connect process. So essentially tokenizing all of the assets going through the northbound stock connect into China from international investors. And we have been throughout our journey. We closed that deal when we were just doing smart contract deployment. This is on a database. It wasn't anything blockchain related. It wasn't distributed ledger technology related. And even at that point, the importance of being able to implement something new and something revolutionary required privacy at its most kind of core function. Being able to outline who sees what, when they see it, and which legal entities are required to see it in an atomic and scalable way was something that we saw very early on as being incredibly important. Again, in Hong Kong, one of our clients include HSBC. We digitized their tokenization platform, HSBC's Project Orion. And again, this enabled them to be able to create these granular controls around who sees what, how they see it, but it doesn't prevent them from being able to extend it out to additional networks. I don't know if anyone in the room was at the Hong Kong Jockey Club last night, but
I really like how she mentions additional networks. I feel like there's a lot of tribalism in this space around Canton because it, to some people, came out of nowhere. But what you'll notice is that Canton was built in such a way to work and be operational in a multi-chain environment. And everybody that works at Digital Asset and represents Canton Network has verbally disclosed that that's exactly the way that it was built. So last thing, go ahead, Aqua, what were you going to say?
I was just going to ask you, did you see what Canton posted right before we got on our pod this sunrise?
Nah, bro, but you can bring it up and bring it to the table if you want. I'm going to play another video clip real quick.
Okay. All right. Yeah. No, run it and then I'll share. But they shared a DeFi platform, and it has 2 pools on it that are live right now. But yeah, I'll show it once you're done.
Well, take some time, click around on it. Let me finish this. Let me finish this breakdown so that way you can pull it up and go through it. I'm gonna go over the bronze strat real quick and then play those other 2 clips from these gentlemen here.
All right, sounds good, bro.
All right, bet. All right, cool. Here's the foundation. So she goes on to talk about how the foundation is here and that more people will build on Canton. Take a second and just listen. This just gives, I feel like, a bullish outlook for the Canton network moving forward, considering some other things that I'm going to play for you guys here in a second.
With HTTPS, it's sort of immediately clear what the safety benefits are for the user, right? Of like not getting phished, knowing that they're connecting to the correct server that they're connecting to, knowing that like their data isn't leaking out into the world for bad actors to take advantage of. And in crypto, like all of these same things are true, right? But it's just not as like immediately clear to everyone involved that you do have like very important safety concerns when it comes to not transacting in private modes. So I think, yeah.
5 years, 10 years.
Yeah, you view in 5 years, 10 years.
5 years, 10 years. I mean, I think we've started the implementation for it. I think now what we're going to see is just significant more adoption to the Canton network and a lot more traffic there. Because at the moment, what it is that we need in the future, the brickwork and the foundations for it are being built now. So TPS.
And so, you know, she's just talking about how more foundations being built out and how more people will use, more businesses will use Canton network. And then here we have a gentleman sitting on stage from EDX Markets. And he goes on to talk about how JP Morgan will use Canton network when they're repoing to the Fed when they want to use privacy features. Take a second here and listen.
I mean, I think it goes back to kind of what Andre said about convergence and hybridization. So you've seen some private chains used by banks like JP Morgan to move deposits around internationally, and maybe also for tokenized deposits for their clients. But you also need public clearly private blockchains weren't the solution because public blockchains have outgrown them massively. So for retail facing products, you know, if I was just to put on my prognosticator hat, it would be public blockchains for retail application because of the openness. And then when JP Morgan doesn't want to see, you know, they don't want everyone to see what they're repoing to the Fed, it'll be a private, you know, Canton or something else like that. I mean, I think it goes.
Last video clip I'm going to play is this video clip here from the Empire and Canton podcast Quadrillions that was dropped 2 days ago. Still has less than 1,000 views, which is mind-blowing to me because there was some super bullish stuff said in this podcast here. But this gentleman from Goldman Sachs, so just remember the lady from Digital Asset mentioned that HSBC built the Orion platform on top of Canton. Well, here you have another representative gentleman from Goldman Sachs talking about how they're also building on top of Canton, which is just super bullish confirmation that Canton is for a fact. It's not, you know, we can speculate and find documents on Canton and post them on Twitter and whatnot, but when you actually get verbal confirmation from these people on stage, broadcasting this info to the world, it's like, yeah, wake up, this stuff is real. So this is a gentleman directly from Goldman Sachs, and he specifically mentions not only are they building on Canton now, have built on Canton, but that they're planning to build more applications on top of Canton in the future, which is just super bullish in my overall opinion. Take a second here and listen.
Matthew, what do you see? I'm sure you guys get pitched all the time from crypto companies and crypto founders, and you know, the Ribbit portcos are coming into Goldman's office trying to say why, you know, Goldman should build on top of them or something. What do you see crypto companies get right and get wrong when they're coming in for an institutional pitch?
I think we've kind of touched on some of it already, to be honest. I think, you know, for us, and, you know, not kind of wanting to labor the point, but I think, you know, the stuff that really kind of focus, you know, our attention is kind of the governance, the privacy, interoperability. And I think, you know, Yuval's talking about the tokenomics with regards to the Canton network. I think being rewarded for developing applications that we see actually have true foundational value kind of in the financial system These are things that really kind of resonate. And so, look, obviously, naturally keep an open mind, but we've, found with the Canton network that really kind of does, kind of offer a lot of what we're focused on, which is why we've been very, keen to continue to develop all of the kind of DApp applications there.
Yeah. Are you guys are building on Canton?
Yeah.
What are you building?
Well, the digital asset platform is an application on that, and then there's things that will be developed in and around that. And
Nice.
that, as we start to think about, because I mean, really fundamentally where you want to get to is a place where if I'm a kind of repo trader or I'm issuing equities, that we're not talking about the technology. We're just kind of really reaping the benefits of the underlying technology. And I think that's the kind of key kind of place we want to get to. But you need to kind of replicate today's financial system on those rails, which, easy to say, not that easy ultimately to deliver, certainly in the short term. So for us, that, is kind of the real foundational, focus. So everything that we look at, and you can really, going back to the first comment I made, kind of way back when, there really wasn't the obvious commercial, value propositions in many of the things that we looked at. Now it's very clear where the value proposition is, and those are the areas that we're very focused on. And in part, that's because of broader adoption, the evolution of the technology. But again, it needs to kind of go back to those core tenets that we talked about. One of the other kind of things I'll pluck on, you talked about kind of what are some of the misconceptions.
So anyways, that's a gentleman directly from Goldman Sachs, specifically talking about how they're built on Canton and they plan to continue to develop and build on Canton. Huge confirmation verbally from an industry leading expert in this space.
Yeah, super major, bro. I love how Yuval's just chilling in a hoodie too, bro.
He always just looks like he's ready to go on a run or something. Like he's just chilling.
Yo, that dude can run. He posted a post that he took a run. I think it was, if my memory serves me correct, like a 30-mile run, bro. I think it was like 4,000 calories he burned, but he took a screenshot. It's on his X account. You can go probably scroll down and find it. But yeah, talking about running, speaking about running.
Since we've been on the topic of DeFi developments across the board, me and Aqua have covered and talked about the Braun rewards over, or the Canton rewards over in the Braun wallet. However, in discussion yesterday with one of our members brought this to our attention where, I only personally have half of my position on Braun wallet because I'm diversified just in case something goes wrong with Braun wallet. I don't have all my eggs in one basket, but the coins that I do have right now on Braun wallet are in fact earning me rewards. And these rewards have been coming in steadily for months now, right? So this has been great. And you can see all these rewards here. But nonetheless, these features, these tier features over here, one of our members was talking about how, in order to get upgraded to the higher tier, you need to have 100,000 Canton coins and 100,000 Braun tokens. But some people might not have 100,000 Canton tokens. They might have 50,000 Canton tokens or 20,000 Canton tokens. And so what you can do is you can delegate and create multiple accounts, multiple wallets in the Braun wallet, and you can have 10K on one wallet, securely earning the 10K rewards. And then you can have another account, right? So if you have 20K Canton tokens, you can take that 10K Canton tokens and put it into a separate account, and you can earn rewards on that 10K Canton as well, right?
Yeah,
which I thought was
facts.
cool because he was expressing how he only had 50,000 Canton tokens. And so obviously, of course, that doesn't give him access to the higher tier rewards, but having more than 10,000 Canton tokens, if you're accessing this reward tier, doesn't give you more rewards. So how can you go around that? You can create multiple accounts. Braun allows you to do that. And then in each account that you have, you can segregate 10,000 units of your Canton to that account. So that way you fit into that reward category, that reward tier in that specific account.
Yeah. And it works on sub accounts too. So like on that Dropbox where it says CyberX workspace, you could, or the plus sign right there, I believe it is, but you could add the sub account within your main account connected to your main email. I didn't know that. So what I did last month, because I have 200K Braun, I was like, all right, let me just create a whole nother one with a separate email. So it works both ways. So you can create a whole separate email, or you can do that sub account within your same email. So yeah, either way, you're going to be earning, and it's very intelligent thing to do, in my opinion, because I'm holding 200K. I don't quite have the 500K, but I'm capped out at 100K. It would make sense to do exactly what I did, split it up, 100K, 100K. So yeah.
Yeah. Last thing I'll share before you bring that protocol up to everybody's attention. This is the last thing that I have to share for everybody. Shout out to Hypebeast ETH. He's always dropping Canton gems over on X. If you guys don't follow him, give him a follow. He says BlackRock and Canton, Theramune changed their ticker. This is huge in my opinion. Changed their ticker to CNTN, or the Canton debt. Okay. Excuse me. And we know just a few, what is it? I don't know, maybe, let me see how many weeks ago, 3 weeks ago. Okay. 3 weeks ago, BlackRock invested $100 million into Theramune, right? Theramune is obviously, of course, well, it's changed now. They changed the name. I'll go over that. But Theramune is the only publicly traded company building a Canton digital asset treasury as of time of recording this particular video breakdown, according to official announcements. And if you come over here to the Theramune X profile, what did they just announce? This is huge in my opinion, considering BlackRock freaking took up $100 million stake in them. It says, we just rebranded to Canton Strategic Holdings. Our new name reflects what we do. Build a diversified digital asset strategy around Canton Network, where we operate as a super validator and long-term ecosystem participant. Our capabilities are aligned with this infrastructure, securing the network, supporting interoperability. So I just think it's crazy that a company that BlackRock invested $100 million in just literally changed their name to Canton Strategic Holdings. That to me is huge. And then if you come over here to their official announcement of this, right? Canton Strategic Holdings, down here at the bottom, it specifically says, we believe that Canton Network's blockchain tech is transforming the future of global finance, connecting some of the world's most trusted institutions on a single, secure, and interoperable blockchain with trillions of dollars in assets on the chain and the support of leading institutions. The Canton Network delivers a real-world performance, privacy, and atomic settlements. So I just thought that was pretty dang bullish, considering that BlackRock publicly announced a $100 million investment into this company, and then this company goes and changes their name to freaking Canton Strategic Holdings.
They knew that. You can't tell me BlackRock didn't know that. These guys are
110%, bro. Of course they did. So that's all that I had to share today, bro. If you wanted to take over the ship and share what you had, you're more than welcome.
Yeah. So Canton today just posted this. You can see my screen, right?
Yes.
All right. So it says Tradecraft has launched as a Canton native DEX, enabling on-chain trading without exposing strategies, positions, and counterparties. Here's what you need to know: AMM-based, privacy by default, built for institutional grade real-world assets. And when I clicked on it, and again, this was just posted 2 hours ago, it takes you here, and this is probably one of the most simplest protocols I've ever seen. And the reason why it's so simple, as I was clicking around here, basically it's your assets stay in your custody in your wallet, right? So basically it says here, add liquidity from your main wallet. Problem, it says, as of yet, there are no browser extension wallets that connect to web apps. For the Canton network, you typically need to operate a node in order to use apps on Canton. Solution: interact with Tradecraft using standard send and receive transactions, send to bespoke Tradecraft address, get tokens back safely and atomically. And when I opened up the white paper of the docs, basically kind of goes into detail. I wasn't able to go through everything because we've been on this call, of course, but it definitely supports Braun Wallet, right? And then what I highlighted here, looks like my highlight went away. It says, how is this non-custody? And I'll just read this here briefly to you guys here real quick. When you send tokens on Canton, the recipient must accept the offer before the tokens leave your wallet. When a pool address sees your transfer, offer it, it will accept the offer, perform the operation, and return the correct tokens atomically, meaning the operation succeeds in whole, or else it is reversed. If it succeeds, you have your return tokens. If it fails, your transfer offer remains in place until expiration, when the tokens automatically return to your available balance. So basically, in a nutshell, from what I've gathered, to participate, it looks like there's two different pools here. One of them is really healthy in my opinion.
Are you sharing another screen, bro?
I am. Hold on. Yeah, let me. My bad. I've been on Tradecraft this whole time. My bad. So yeah, these are the two pools that they offer right now. This pool right here is like the most healthiest. It has a $1.6 million total value locked, offering a 17.22%. But one thing I'll point out, this is not financial advice, of course. Don't tap into liquidity pools unless you know exactly what you're doing. But the one thing I'll point out is, just looking at this pool and kind of just getting excited and going through my standard procedure to see if it's something I want to tap into. When you come over here to DeFi Llama, this is one of the tools that we share with inside the Wealth 28 Club, as far as, are your two assets correlated, right? And here on the correlation matrix calculator, you got Canton and USDC not having the best correlation, right? So when you go on to the 1 minute, it's minus 36%, the 7 day minus 23%, the 1 year is literally 2%. So there is potential to basically have some impermanent loss, right? Wait, did I stop sharing my screen completely? You can still see my screen, right?
Yeah.
Okay, cool. But yeah, this is the reason why you want to be tapped into a community that knows what they're doing and has been tapped in for, over 2 years now. So, but yeah, this is just more development on the Canton network. It'll be interesting to see this one grow. I don't know how new this is, right? As far as like when this actually dropped, because it looks like this just came across my desk, 2 hours ago following the Canton network. So it'll just be interesting to see the next 30 days, this Canton, and it looks like wrapped Bitcoin, to see where that goes as well, and just where this whole protocol goes. But just something that's legit on top of the Canton network, that we could start getting our Canton working for us, not just within our Braun wallet or any other wallet that connects to the Canton network. So yeah, that's it pretty much that I have.
Heck yeah, bro. That seems awesome. I think that'll wrap it up for today. We've been on the call for going on 3 hours now. So great call today, man.
Yes, sir.
Blessings to everybody. You guys have a good weekend. Take it easy. Remember, none of this is financial advice. We talked about XRPO. We talked about Metallicus. We talked about Canton. We're not telling you guys to go there and buy any of those digital assets. Always do your own research, and obviously, of course, make your own risk-assessed analysis. But blessings to you guys. Be cognizant, be aware out there, and we'll see you guys next Friday. Everybody take it easy.
Peace. Much love.